this is shaping up to be a kind of reset in Fed funds pricing, where the markets essentially say, right, so they told us 100 basis points in December. They reiterated 100 basis points in March. It's 100 basis points. That's baked into the markets now over the course of this year and next. The markets are a little bit more urgent looking in the way that they want the easing to be delivered. The Fed has a 50-50 split in their forecasting. The markets are 69 basis points this year, 31 next year, so they want more cuts sooner, as it were. But the upshot is the markets don't really see any kind of recipe here for the Fed to get out in front of whatever's coming. And that's probably not good news for risk sentiment. But from sort of the rates pricing perspective, the markets are looking at this and going, yeah, we're not going to get anything here. They're not ready to tell us anything new.
Mike, before we get to the Fed on Wednesday, we have a few earnings reports. I didn't see the Palantir numbers yet, but there's Palantir, there's AMD, even on Wednesday morning, Novo Nordisk, Uber, Walt Disney. Any of these earnings reports catch your attention? Because it feels like the broader markets, as you said, lots of chop and churn the next few days. So if people are looking for some action, they may have to turn to the earnings calendar prior to Wednesday.
Yeah, and that's kind of how we've operated in low vol environments. We pay a lot more attention to these earnings reports, but yeah, Palantir is chopping around. It looks like it's down a point. I don't know if it's moving, so I don't know if it's out yet officially, but I know we have an AMD earnings preview on the News and Insights tab on tastylive.com. I'll put a link in the YouTube chat right now for that. We've got a Disney one coming out, if it's not out already, and then a Uber one coming out. Uber is interesting because Uber, if you look at the timeline from when the E-minis and NASDAQ and everything started selling off with the tariff implications, Uber has kind of avoided that, and they're actually all trading at almost all-time highs right now. A lot of people are thinking that autonomous drivers are closer than we think, which is scary for me because I don't see myself getting into a car and looking at the front and seeing a mannequin with a taxi hat on talking to me, you know?
Right. If it was like a mannequin, like a bicycle or a rickshaw, I'd be okay with it, but not a sedan.
Yeah. Yeah.
At this point, increasingly around here in San Francisco, there's nobody in that front seat because the car drives itself.
Perfect.
Oh, well, look at you, fancy.
I feel like they should put someone in, put a mannequin up there. At least
It's the Mike Butler Jobs program. You get a taxi cab attendant. Someone offers you mints, changes the radio.
Yeah.
Right?
It's not the world's worst idea.
Mike, you mentioned Palantir moving around here after hours. Earnings are out. They met their EPS at 13 cents. We see here revenues slightly higher, $884 million versus $862 million expected. Their commercial revenues in the U.S. are $255 million, which is noteworthy because it's a 71% year-over-year growth rate. 39% increase in customers. They're guiding higher for 2Q at $936 million versus $899 million for revenues. And their fiscal 2025 outlook has been up to $3.9 billion versus an estimate of $3.75 billion. So Palantir a little bit softer here after hours. It's one of the names that's certainly on the docket. Mike, you were mentioning Uber, though. I didn't have a chance to bring up that chart here. Obviously not something that we talk about a lot here, Ilya, and I have my own personal gripes with the company. It's not because of my own rating or anything. I just think that they don't pay their drivers enough. But Mike, it's approaching all-time highs right now. Is this tariff-free? I mean, I feel like if people are traveling less for business or pleasure, it's probably not immune. But you think there's a bigger story in here. You think that there's a story about automated driving that, someone like Elon Musk has been promising us for the better part of a decade. Waymo exists in San Francisco, and Uber is looking to on-ramp that technology sooner than later.
Yeah.
Yeah, I think if you remove like you said, drivers not being paid enough, but if you get rid of the driver itself, that could be good for shareholders. But in the light of
happy thoughts.
Yeah.
You say it was like a question mark. Like,
yeah. I mean, in the light of
for other people.
Yeah, right. Being recession proof, I mean, I use Uber and Lyft. Like, I have a car, so I don't really need to use Uber and Lyft all that often. But I also live in Chicago, where if I really wanted to get around, I can public trans anywhere. I can take a bus. I can take a train. That's not necessarily true for cities that don't have that, or at least as built up as something like Chicago. So Uber and Lyft are still cheaper than owning a car, paying for gas, paying for insurance, hitting the monthly car payments. So I don't know. I think it'll be around. It's just a matter of whether there will be someone driving us in the future or a mannequin. I'm going to really push for that mannequin idea.
One interesting thing, actually, to this point, S&P Global came up with their revised service sector PMIs today, and there were some interesting tidbits here inside the report.
Before you get there, Ford is also out with their earnings report. They beat on their EPS. 14 cents versus an estimated loss of 4.3 cents. But they do announce, and revenues are up, Blue's up, EBIT's up, right? So good numbers. But the tariff adjustment, they're seeing that there's a $2.5 billion tariff impact. They're going to be able to recoup $1 billion of those costs. They are hereby suspending their fiscal year forecast due to the tariff uncertainty moving forward. So net projecting a $1.5 billion hit thanks to the tariffs. It's lower than some of their counterparts. GM is up over $3 billion. But in any event, share prices down here. Another company suspending guidance, the market not treating it fairly, even though everyone kind of knows it's coming.
Well, in a sense, actually, this is perfect because obviously we're talking about Uber, a user of cars, and here we have Ford, a maker of cars. This captures nicely the messaging from those PMIs I was just mentioning. Here's a quote from Chris Williamson, the chief business economist at S&P Global. In that report, he writes, higher prices paid for imports due to tariffs are also driving up service sector firms' costs, as opposed to just manufacturing, feeding through to higher prices, notably in consumer-facing industries such as restaurants and hotels. In other words, if you make the inputs for service providers more expensive, and you can go ahead and put Uber there in the same category of client-facing service providers, if you increase their input costs, you're going to increase their costs. And if you increase their costs, you're going to increase the prices to consumers. So enjoy that.
No, thank you. Look at the broader index levels today. S&P 500 up by 0.71%. Ilya, it's a touch softer than when you and I were talking today on Futures Power Hour when it was sitting at closer to 5690 or so. A little bit of weakness. It's not significant, but a little bit of weakness here into the close. It's still an inside day. So I suppose to Mike's point, he's saying expecting more of the same that we had today for tomorrow. That comports with what you and I were suggesting a few hours ago, which is that ahead of the Fed, it's such a gravity well of attention. People like to keep capital, set aside so that they can trade after the event. The volume here today is minimal. We don't cross a million contracts traded. Forget at the halfway mark for Futures Power Hour. We can't get there through the end of the session. So it's exceedingly light trading today. It's a little bit of an inside day. You don't really make too much of that on a technical basis. Ilya, do you still feel, as you did midday today, and I already know the answer for this, but we need content. Do you feel like it's a better short?
I'll say it again, boss.
Do you feel like it's a better short here than a long, given how far we've traveled, and even though we just broke the streak of 9 straight days?
It is. And I think, I don't think it's pretty clear. I got into this fading it much earlier than was advantageous. Let's say it that way. But I remain unbowed here, as it were, because that area you're showing us here marks a full reset of basically the Liberation Day gap in the S&P. In other words, we have our hair on fire moment in April, where for a second there it looks like the reciprocal tariffs are so disastrous that what they're going to do is basically blow up the treasury bond market and the dollar. Because what they do is they essentially amputate the U.S. out of the global trading system. And if you did that, then you rob that system and the global economy of basically its risk-free asset, the treasury bond, and its unit of commercial exchange, the dollar. So, needless to say, the markets have a conniption. We very quickly step away from the brink there as people sort of come to the realization that you can't extricate these assets from the global financial system, and the administration has a pain point where if you reach a certain degree of chaos in the bond market in particular, they'll back away. And so we seem to have gone the full ride in April and come all the way back. But where have we come back to? The range where we settled after the growth spook in mid to late February and into mid-March. So we're just back to regular recession fears now, not existential crisis, meltdown of capitalism type of price action, just regular old growth, slowdown, and recession. And so has that story changed? No. In fact, we just saw the ISM and those S&P global PMI numbers this morning, painting from different angles, but telling us the same thing. The U.S. economy is basically at a standstill. All in. S&P Global was a little bit rosier on manufacturing, worse on services. ISM was a little bit rosier on services, more downbeat on manufacturing. They both landed about the same, which is PMIs at basically neutral, nothing, standstill, which is a huge reversal from the very buoyant growth we saw last year. And certainly comports with what we saw in the first quarter GDP data last week, even when you take all of the tariff weirdness out of it. So we're in a situation here where risk is very much on the downside, and the risk reward is too. If you're wrong here betting short, you're wrong quickly, because you have very clear lines of resistance at the top of this congestion range from March in front of you. It's close by. You get over that, okay, it's going higher. Get out of the way. You're wrong fast. But if this is the retracement and now we get into the next leg of a more orderly bear market, then you have all kinds of downside here.
Mike, every day the CBOE, or CBO, I should say, they send out a report about what's going on with volatility at the end of every session. The title of the report they just sent out was Option Market Signals Skepticism of Market Rebound. I thought this would be fascinating because it kind of speaks to what Ilya's been saying here. But in their cross-asset volatility overview, they note that implied volatilities fell across asset classes again last week as risk assets extended their rally, with the SPX index retracing its entire post-Liberation Day drop. The notable exception is oil. WTI 1-month implied volatility skewed over 7 points to 50.6% as oil prices slid to a 4-year low. Oil skew also steepened notably, with the 1-month 25 delta spread widening to 13.8%, exceeding the highs we saw immediately post-Liberation Day. The oil volatility market is signaling rising risk of global recession, while the equity and credit markets are extremely sanguine on such risk. Do you find that the equity market is a little bit complacent here with how volatility has evolved? It's sanguine on such risk in the short term?
Yeah, for sure. I mean, this was the first red day we saw in 2 weeks, 2 straight weeks, if I'm not mistaken, with the holiday at the end of April. But yeah, I was actually going to ask you guys what, for such an inside day, the continuous sell-off in oil really stands out to me. But from the equity standpoint, you would think that if all was fine and dandy, rallying from 4,800-ish to 5,600, almost a 1,000-point rally, that you would see volatility futures in contango. You would see them come out of the 20 handle range back to the teens, but we're not seeing that. We're still seeing backwardation from the K to the M contract. It's not substantial, but it's still there, and we're still in the low 20s all the way through the end of the year. So there's nothing on the volatility curve that tells me that we should just expect this rally to continue. I think we're still here for some chop and for a narrative to develop, because I feel like right now we're kind of in this, like Ilya said, we're in this range of like whichever direction we're going, we might see that continue. And if it's to the downside, we'll see volatility pop, of course. But yeah, what do you make of the oil market not being able to catch a bid?
I mean, Ilya, gold and oil and the dollar are existing in a completely different world than stocks right now. The dollar hasn't recovered. Gold's ripping again.
Yeah.
Oil's falling apart.
I think oil is a particularly interesting one. So I was short oil for a few weeks, and I got out of that at the end of last week because it looked like we'd hit a level of support at former lows. Obviously, we gapped lower here at the start of this week, but we're not really making any sort of concerted progress on this down gap. In fact, if you look intraday here at oil, it's not looking anything like where it was at the lows. And in fact, on the day, it's sort of narrowly a rise relative to the open. It's down largely because of the gap at the weekly open here. If not for the gap, we'd be up on the day, albeit very modestly, but up nevertheless. I think we've kind of gotten to a weird place on oil where the story is clearly of demand destruction, clearly of weakness, but maybe this is sort of the flip side of the risk reward in stocks, where you don't have a lot of room on the downside relative to where that swing low is, just above 54. Not much room there to keep pressing this. Whereas if you corrected, let's say, in the direction of 64, lots more room there just to test the upside of the most recent swing. So I'm not in this market at the moment, but I would be somewhat reluctant to short it for now. Maybe we get something a little bit better in the second half of the week. Either we crack that low or we correct a little bit higher, maybe in the, let's say, in the direction of 60, 62, right where, Chris, you have that 21-day EMA. Maybe we get somewhere kind of in that area. Not because the EMA is there, but of course because there's a horizontal axis through the middle of that range running right there. And so maybe there is some sort of a sticking point there, and that's a better spot from which to trade. But risk reward here seems a little off. And I think largely it's because who really believes OPEC Plus when they say they are going to discipline their members to cut output and get into the business of selling cheaper oil? What oil producer do you know is in the business of selling cheaper oil? That's not how they operate at all. They, in fact, are price takers and price followers, not price makers, much as they'd like to pretend otherwise. The U.S. is now the biggest producer by far, producing more petroleum products than Saudi and Russia combined. Mm-hmm. So who are they kidding? They haven't been able to build up market discipline around getting their membership to cut ever. So what we're going to have here, it looks like it was a gap because OPEC said, oh, we want to cut output over the weekend, but ultimately a move that goes nowhere because who believes them? So crude might correct a little here. I'm not ready to sell it again yet.
Mike, do you have any feelings on crude or any of the energy companies? Because despite the sharp sell-off in oil, energy companies are kind of holding up. It's not like Chevron or Exxon or Schlumberger are really taking it too hard on the chin, right? Schlumberger hasn't done anything for the better part of a month.
Yeah, actually, I pretty much am always in crude oil by way of a micro contract. So I just try and get long into these dips. Unfortunately, when I bought the initial dip, it was at like 66. So I have a micro crude contract at 66, but I've been using the crude futures larger contract to sell a call spread against it. I actually just closed that today for a successful hedge. I initially sold it for $220 and I bought it back for $20. So I secured a $200 hedge against the crude, the micro crude contract, which brings my basis down to 64. So I'm basically just going to hold it and see if we can get a little rally here. But if not, when I roll from the M to the N contract, I'll just throw on another spread around 64 and just try and bring the break even down with a short call spread in the bigger contract versus just holding the micro. But yeah, right now I don't have any other positions on in energy futures or energy products. But I did just close a live cattle contract call spread into this.
A name I haven't heard in a long time.
Yeah, it's basically just skyrocketed. Thomas put us on this one, and it was nice.
Of course he did.
Yeah.
Can I provide some interesting information that Tyson Foods came out with today? They had their Q2 earnings estimates. They said that ranchers can stop culling their herds moving forward. So that's obviously not something that's going to happen overnight because cows just don't grow overnight. They have gestation periods like other mammals. So we probably wouldn't see something longer term come into play just yet, but I think it's worth noting that there had been an intentional effort to dwindle the cattle herds here in the United States, and maybe that's a policy on the mega big agri level that's going to change sometime soon. So certainly like that piqued my interest today. Plus more cow means cheaper steak prices. Who's not in favor of that?
True.
Ilya, I would point out one thing. You were mentioning something with respect to oil, although it's now slipped my mind. So I suppose it's as good as ever. We're halfway here to I was going to do the sector rotation, but I just saw a red flashing headline. Credit Suisse to pay $511 million for helping U.S. taxpayers hide over $4 billion overseas. It's a damn shame they went away. They were a real, they were a special shop. Energy sector is your leader to the downside today. Of the 25 ETFs that we track here on Futures Power Hour, only 3 were in the green. Yikes. GDXJ up 3.5%, 4% respectively. On the other end, oil down 2.41%, and IYE is off 1.82%. But even so, when you look around, forget the energy stuff or the commodities, XLY is off 1.06%. Not a huge loss, but it's a growthier name. XTL, SMH, lots of struggles in the names that we want to look at here. Ilya, I know that being bearish is something that you very much have your eye on the ball with right now, even if it's been a struggle here. I would point out to people, as I said yesterday on First Call, as I said here on Futures Power Hour today, we just saw 9 days in a row up in the S&P 500. You go back to World War II, 80% of the time that you see rallies of 9 days in a row or more are occurring in bear markets. So it's been a really fun run. Probabilistically, do we think this is one of the 20% outcomes or one of the 80% outcomes? I know which way you're thinking.
Yes.
For the sake of the Fed meeting this week, though, let's get away from stocks, which may be looking at disappointment. Chew on the theory that a Fed rate cut is good or bad for the bond market for a second. What's the context here? Why should we be looking perhaps long bonds and then ultimately long gold perhaps, which I know you got on board with today?
I did. I think you almost certainly, if you look at the Fed funds pricing, don't get a move from the Fed on rates. that sets up an interesting calculus. If you look at where the markets are thereafter in terms of their baseline, nothing happens in June, but ostensibly that's the stage setting. So the Fed comes out in June, gives an updated summary of economic projections, says more about where it thinks inflation and growth are going, as well as rates, of course. And then in July, they move. Now, if that's the playbook, then there really isn't any added urgency in what the Fed is doing. And based on what the Fed told us back in March, you might surmise that they don't have a reason to, because their entire shtick has been, look, we know that historically tariffs are bad for growth and inflationary, but we don't know what's going to happen this time. And until we get definitive hard data that tells us whether we should be prioritizing employment or inflation, we can't do much of anything. So we're just giving you a repeat of what we said in December because we don't have anything new to add for you. This looks like it'll be a meeting about those kinds of things. And again, the markets want them to be a little bit more urgent. They want them to front load the rate cuts a little bit. Fed is probably not in a position to say anything like that because they don't have that hard data. NFP is a great dichotomy. GDP is a great dichotomy. GDP was negative, but strip out the front running of tariffs via building inventories and surging imports, and it's not so negative. It's not positive to the extent that it was last year. It's a slowdown, but it's not so negative. NFP, a little bit hotter than expected, but the prior month revised by almost the identical amount that this month beat forecasts. So is it good? Is it bad? Is it indifferent? From the Fed's perspective, they still don't have the kind of uniform clarity, and all of the squawking from the White House makes them, in my mind, reluctant to look like they're kowtowing, even though the president has sort of backed off a little. So they have every reason not to do anything any which way supportive of what the markets want, which is more stimulus. They're not going to be hawkish, but they're also not going to be any more dovish, most likely. And that probably means a rehash of what we saw in markets last year, when the Fed was resistant to cut going into the second quarter last year and through much of it, even as the markets were getting increasingly worried about growth, they started to put more cuts later downwind and said, oh, well, they're going to drag their feet, so they'll need to do more later. And that meant that the long end saw a good bit of strength as rates fell there much more aggressively than they did at the front end. You sort of set up that kind of dynamic here. You get a Fed that probably says, we don't know, see us in June. And the market goes, yeah, we do know though. And you can tell because the break-even inflation numbers are falling. So the markets have already given the Fed clearance to cut. But the Fed's not going to take it, it looks like. So you get to a place where the markets go, right, so now you're late, so you'll cut more later. And that's probably constructive for the likes of ZB and ZN.
Mike, do you have any strong feelings on rates here? 10-year yields up 20 basis points over the last 3 sessions.
My gut feeling is that this is going to be similar to last year, where they said, well, what do we have last year? Like 6 rate cuts or 7 rate cuts that were projected, and then we did not do that.
At the start of the year.
No. And now, like, the same thing this year. Like, what was the beginning? I think it was a similar thing. It was like 5 or 6 this year at the beginning.
No, so the markets actually started off very light this year. They were at just 50 basis points at the start of this year, all the way out to the end of next year. So the markets only had about half the rate cuts that the Fed thought they would need. The Fed was on the hawkish side of markets at the start of this year. Now they're basically as of today, they're almost in perfect alignment.
Yeah.
It's just the markets want 3 this year, 1 next year. The Fed is saying, we'll give you 2 and 2.
Fair.
Yeah, what it makes it interesting is that you think that the Liberation Day tariff impact would be bad for growth. The market's actually pricing in, compared to where we were when the final, we get them on April 2nd after hours. So April 3rd is the first close. We open up with a greater chance of more rate cuts by the end of the year immediately after Liberation Day than we are right now. So the market's telling us that we're away from the panic about growth and an immediate slide into recession. Mike, there was a point earlier this year, April 7th, where we were pricing in basically 5 cuts. We're effectively back to 3 right now. At the end of the day, I think the big news is what happens to rates is going to be kind of an inverse reaction of what happened in September. Ilya, you and I mentioned this on Futures Power Hour, and I think you, me, and Tom and Pete were all in agreement yesterday on First Call, which is somewhat of a scary prospect, but I digress. The bond market in September got a 50 basis point rate cut, and then yields went up at the long end of the curve. And our immediate reaction that day and the immediate days thereafter was reflation. The market is looking at an economy with a 4% unemployment rate or so and a 2 handle on inflation and stocks near all-time highs. And so cutting rates in this environment is going to, if we're correct about reflation, it's going to push up yields. Now, of course, I didn't capitalize that on the bond side of the story. Got it right in gold and stocks, but bonds, we kept the long bond position on in September, October, much to the chagrin of the P&L in the portfolio. But that happened because the Fed was fanning the flames of growth and inflation with lower interest rates at a time when the economy was strong. So reflation comes in, bond yields go up, bond prices go down. The Fed keeping rates on hold this Wednesday at a time when the market is seeing inflation concerns percolate, it's probably good that the Fed's not going to cut for bonds. If they were to cut with these inflationary embers burning right now, you get that September scenario where all of a sudden the Fed's actions look reflationary. They're fanning the flames of inflation, as it were. And so you have to pump back an inflation premium at the long end of the curve. Likewise, I think there's an argument to be made that given, the executives meandering, or rather loitering around the Fed's privileges and authorities, trying to dictate policy outcome, if the Fed were to cut immediately, it would probably stoke speculation of loss of independence once more. Did the Fed do this
or
because
some such thing?
So the term premium can come back in a little bit too.
Yes.
So all of a sudden you have term premium inflating, you have growth inflation expectations inflating. So the Fed cuts, long end yields get blown out. I think the Fed is not going to do anything this week. I think that they're going to signal unease about doing anything in June because there's just not enough information thus far. And there's plenty of time for more data before that June meeting. We're going to get another non-farm payrolls. We're going to get 2 CPI reports, hopefully a trade deal or 2 along the way. So the Fed is going to act. They're going to need to wait to act. But with that background that the Fed can't do anything and the economy is kind of just going as it were, and what's happening with the Taiwanese dollar, of a potential currency devaluation to give the dollar some breathing room, if you want to call it the Mar-a-Lago Accord mindset. Gold's up 3% today. Woo!
Yeah.
Like, Ilya and I talked about gold earlier, so I want to give you a chance to speak in here. What do you take about gold's action after reversing the losses at the end of last week? Bueller?
I don't think he heard you addressing him directly. I think there must have been.
I was addressing you, Butler.
Oh, me.
Yeah, I already spoke to Ilya today.
I thought you said Ilya. Okay.
No,
we went deep on this on Futures Power Hour earlier today, to which I'll say, yes, I'm still long.
I was literally looking at the reference and I'm looking at Ilya just like smiling. I'm like, are you going to say it? It actually is. It's fitting that I am currently the Bueller of the situation that was shot in Chicago. Let me first start by saying I need to praise the gold gods for the move last week, because I had a short GDX position on, and I had a gold. I initially had a gold broke wing butterfly with calls on the upside. And on one of these sell-offs, I bought in the risk, and I created a free butterfly wrapped around 3,200 for $100 credit. It was literally a 10-point wide. It was 30. I think it was 32.10, 32.20, 32.30. Let me double check. Sorry, it was a 3,200, 32.10, 32.20, and into the sell-off last week where we basically touched 32.10. Yeah, 32.09 was the low on May 1st. I was able to sell out of that for 60 cents additional premium. And I took that as a gift from the gold gods. So this is a nice reversal today, but we talked about this before. Like, you shouldn't be surprised to see a little bit of a pullback, even if the momentum continues to the upside, just given the magnitude of the move recently. So I closed all those shorts into that sell-off, and now I have no position on. But nice to see a little rebound here for the perpetual bulls in gold.
Yes, it is. I think today's action is, Ilya, still very encouraging as we go into the close. You're up around 2.4% when you and I were speaking earlier, and now we're sitting up closer to 3%.
Broke back into that range, and that was a nice little indicator for me today, as I was saying earlier. It topped, then established a little consolidation range, then tried to break out, and then couldn't stick it. And as it moved back up, it retested the underside of that range, had a moment of pause to think about what it wants to do with itself, and then broke back in. So it essentially undid a breakout. And that, for me, was emblematic. It showed me that basically there wasn't conviction in the bearish case. And so I sold some puts here today.
Yeah, the 32.75 level, I was buying against that last week when we got that 2-hour chart. If we go over to the 2-hour chart, you'll see that we had the evening star cluster up here, and then we had the morning star cluster down here against that 32.75. And I said, looks good to me. Wrong.
Yeah.
But I was wanting to ride it out down to 3,200 or so, because when we look at the chart, we could see here that you had former highs back at the beginning of April come back into that place. So what happens here now the last 3 sessions, deja vu, we see here at the start of April, a Morningstar candlestick pattern, 3-candlestick pattern up against the former swing highs in February, poking back above that 1-month moving average. And that is the springboard that sends us up to new all-time highs. Here we go again. Morningstar candlestick cluster against that 1-month moving average against the former highs that we had in April. Former resistance turn support. I think gold looks great here right now. And the interesting dynamic, Ilya, that you touched on briefly earlier when you brought up the ETF EWT because of what's happening with Taiwanese equities, but also more importantly the Taiwanese dollar. There's discussion around potentially revaluing the Taiwanese dollar versus the US dollar at appreciation as part of these trade deals, right?
Depreciating the US dollar. This is key here, right? Because a lot of the fire and fury out of the Trump administration is, of course, trade deficits, and a lot of that conversation is not just tariff barriers, but also currency barriers and accusations of currency manipulation, fair or unfair. You be the judge. But the overall story seems to be that maybe what Taiwan is going to try to give the U.S. in a trade pact is a stronger Taiwanese dollar, that is a weaker U.S. dollar that essentially makes the Trump administration feel as though they've made U.S. goods more competitive, which, again, debatable, but that seems to be the thinking.
That seems to be the thinking. Mike, if you're a foreign central bank and you have a lot of dollars on your balance sheet, and there's rumors of a trade deal coming down the pipeline that the Trump administration wants the value of the dollar to go down, and you're going to be holding these green pieces of paper that the administration is trying to engineer weaker, do you feel like you want to hold dollars on your balance sheet, or you think it's worth to put some of those dollars into gold to ride out the storm? I know what I'd be doing.
I also know what you'd be doing. So
Did the framing help?
Yeah, speaking of this, I was talking about this today with Ryan. I had Ryan on from Tasty Crypto on OTC Live today, and we were talking about crypto and everything. But yesterday I saw a Coinbase commercial, and it had to be brand new because I'd never seen it before, and it was so strongly not worded, but like framed in the sense of basically all fiat currencies are going to zero, and you should buy Bitcoin. Like that was literally, it was like, here's a box of 21 million Bitcoin, and then it zoomed out, and it was like, if you look at all the currency that's printed by the U.S., this is what that looks like, and then it zoomed out again, and it's like if you were to look at all the currency that was printed in the last 10 years, it looks like this, and it makes the Bitcoin box look so small, and it really speaks. There you go. It speaks to.
My God, this makes me want to buy dollars, and I'm on the other side of this market.
Yeah.
Damn.
So I was like, did you see this? It must be brand new. I was like, am I getting targeted here? But it's really kind of timely because of all the things that are going on. There you go. Wow.
Those are all of our. See that? Those are all of our exports.
Yeah.
That's what we export to the rest of the world.
Yeah. That was a wild commercial there,
God.
but yeah, I think people are starting to.
How am I supposed to be short dollars now?
Well, actually, let me turn this back on you. I think this is interesting because traditionally, gold, like when I started learning about investing, it was flight to safety, flight to quality, gold, silver. When the market's going down, you invest in these things. Do you attribute the continued run up in gold to people just becoming smarter about currency valuations and actually realizing like, maybe this is something I should be focusing on more seriously, speaking to Bitcoin, digital gold, and physical gold?
No, I don't think so at all. I think the idea that gold is some kind of a haven was just wrong. And it's the kind of shorthand that market watchers use a lot in the kind of what Tom would call the public. But that was always wrong. That was never the case. What gold is a foil for paper currency, because it is obviously a representation of physical value, and it is a foil for interest rates because it yields nothing. So when interest rates go down, in particular when the interplay between nominal yields and inflation expectations give you negative real yields, it actually becomes more advantageous to store value in gold because it has a real interest rate of zero, but that's better than a negative real interest rate. And what then happens is you get periods of gold strength that are essentially a mirror image of what ends up happening to the dollar as a consequence of yields, as a consequence of expectations for rate cuts. So you get this perception of gold as a haven because the same kinds of things go up when you expect for there to be some sort of economic turmoil, that is bonds and gold, and the same things go down. It's not because gold is safe. It's because it's a function of yields, and it's a function of the dollar. And so when the central bank, in particular, of course, the Fed, is expected to cut, dollar weakens, bonds go up, usually. So it's, in my mind, a misunderstanding of what gold is fundamentally, and has always been. Let's go back to 2022. All year, gold and stocks fell together. Why? Because the Fed was raising rates. It was about rates. It's always about rates for gold, ultimately. So I think when you look at this kind of surge in gold, what you're looking at is almost like a war premium. Gold surged when it did when we saw the response to Russia's invasion of Ukraine. It does have some kind of a, I don't know what's going on, fog of war bid episodically. And I think we've seen it have that here around the trade war and all the uncertainty. When people don't have any better ideas, they go, you know what? The fog is too thick. We can't see that far. Buy gold.
I'd rather
when it comes to yields and the currency. And obviously, April was very much that story. If we now go to a regular risk,
2000, worth. Gold has outperformed the S&P 500 since
that's right,
the year 2000.
Well, where have we been biased on rates?
The last few years higher.
Only the last few years, and gold had a terrible.
Gold's got vertical when rates have gone up since
but not since the rates have gone higher. Gold was not going vertical when the bias was to hike. In fact, all of 2022 it was falling with stocks. So it's come back since the conversation has become cuts again. And obviously in April had a little bit of extra juice to it around these kind of sell America hair on fire concerns, which clearly have now washed out of the market. And we're sort of back to regular recession. Notice, by the way, bonds have unclenched but haven't done the full reversal. Neither has gold. The dollar has barely recovered at all. It's been mainly in stocks.
Well, I mean, that's the whole point of that.
And it's because rate cuts are coming.
Well, that's the whole point of that CME note today, right? Or the SIBO note today, is that you're looking at a market where, yes, equity vols come in, credits come in, but if you look at commodities and you look at currency, there's still a great deal of distress that's factored into the system. Mike, you were talking about Bitcoin before, if only to touch on this, as gold looks like it's bottoming. Bitcoin kind of filled the gap while gold was pulling back last week. We have a Morningstar candlestick cluster in gold. We have an Evening Star candlestick cluster here in Bitcoin futures. And so you talk about a sentiment top with that commercial, Mike. Maybe this caters to a little bit of a short-term pullback towards breakout levels around 90,000, 9150, where the 1 month moving average is. I'm still very constructive on crypto in this environment. I feel like something fundamentally broke within the system in recent months, where capital flows are not moving into the US dollar. They're not moving into US assets the way that they once were. And to that end, people are going to reach for alternatives. The fact that the dollar can't rally while other things are trying to recover, while
not a good sign.
Rate differentials are moving in its favor on a day like today, not exactly blowing the lid off the door. Guys,
but you wouldn't say this is because of an existential crisis. You would say it's because just the dollar is weakening on relative yield grounds.
Perhaps. Something did happen over the weekend, though, that obviously draws our attention. He's not exactly our kind of tasty trader, but he is a pretty damn good investor, and that's one Mr. Warren Buffett. Mike, he's announcing his retirement after perhaps one of the greatest runs ever for anything ever. Warren Buffett, from the start of his career until the end of last year, 1964 to 2024, returned 5,502,284%. Over that same time frame, the S&P 500 returned 39,054%. But what really drew my interest is not the power of compounding, which Einstein referred to as like the eighth wonder of the world. It's the fact that he did so with get a keen eye for stock selection, just to underscore how difficult this is to be a stock picker and why trading mechanically around volatility and technical setups, right? This is, as a trader, not an investor, this is why we stick to that as opposed to stock picking. Warren Buffett, from 2016 onward, when he takes his significant stake in Apple, Buffett returns 174% over that time horizon versus the S&P 500's 168%. If Apple didn't get into Buffett's portfolio at Berkshire, Berkshire would have returned 155% over that same time frame compared to the S&P 500's 168%. So a single stock set the difference between Buffett outperforming the market and underperforming the market. And that's really the reason why we rely on mechanics here as traders as opposed to longer-term investors. Stock picking is very difficult. The best guy who ever did it was one stock away from underperforming the market basically over the past decade. So, Mike, as we go into the close here, we have these big events this week. The earnings, they're not so much. We went through all the big tech earnings already. But we have this FOMC meeting this week. For newer traders out there that are listening in, they're drawn to tastylive because there's a lot of market activity recently. What's your number one piece of advice for how you stay mechanical and avoid being emotional during times like these?
The number one thing I can say is trade smaller than you think you want to trade. Because really the whole name of the game is being able to trade in the long run. Like you need to be able to generate whatever your trade idea is, regardless of your probability of profit or what you're doing. You have to be able to withstand any and all variance, and you can't do that if you're trading too large, especially when you're tested in times like this. And I think another thing to consider is just you have to have the mindset of realizing that what we saw in April of this year and what we saw in August of last year, it will continue to happen. It's just the story that changes. The market will always be volatile. Even if the VIX is low, there's going to be things that happen where it pops back up. And your first defensive maneuver is to be trading small enough to be able to absorb that when you can't see it coming. So that's the number one thing that I can say.
Well said. With that, overtime is out of time for this Monday, May 5th, 2025. We'll be back tomorrow, same time, same place. As always, right after first call, 4 p.m. Last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I've been Chris Vecchio in New York. Good luck trading. After a brief break, Ilya's sticking around. He's up next. Macro Money.
See you there, everybody.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
I wasn't going to call you out publicly.
Oh, no.
But I have to.
What?
So we're out yesterday afternoon. So we're driving down Ravenswood. Now, for the people that don't know Chicago, which is most of you, there's a train that runs in the northwest, and then it goes up to the northern suburbs, runs right down the street. So one side of the train is heading south, the other goes north and south, but let's just say it goes north. So we're on the southbound. So Tom takes off in his new fancy electric car, which I can't keep up with. Do you know that there's actually stop signs on that street? Okay.
You blew stop sign?
No, he didn't blow through them. He went from like 40. No, he went from like 40 to 30, and then just kept going.
Oh, I don't stop for stop signs. Because you're above the law. Above the law.
So
That's so bad.
Only for pedestrians.
there's streets.
Yeah, and you're in a bigger vehicle. You can hurt them. They
There's
can't hurt
streets
you.
that go east-west.
I don't go through red light, through stop.
No, just stop signs you go through, not red
You
light.
go through the meters getting on the ramp on the highway. You don't believe in those. You
Oh,
say,
no, those are bullshit. You stop at those?
Yeah, it's the law.
You stop at those red lights to get on the highway?
Yeah, it's the law.
Oh my God, you're
It's so that it's
the
so that
only people that stop
a-holes
at those
like
are
you.
tourists.
It's like a-holes like you,
Right.
Don't make it good for people trying to get on because there's not enough room. They're synchronized for the
Correct.
traffic,
Oh my God, it's
and it's the law.
only for tourists.
Beth, I need some help.
It's the same people that sit upstairs at restaurants. It should say that. I've got like 10 tickets.
Don't you notice that the cars around you slowing down? Like, that's what saves me, is like, I'll be up on like Ashland, because there's so many of those things on Ashland, and you notice the traffic around
No, I never got
you
one on Ashland. I only get them
slows
on
down.
Western and
Well,
Irving.
the same phenomenon, Mr. Pedantic. Oh,
Yeah.
God. Bat, how are you? Jeez Louise. You would not last 30 seconds in an improv class, because the whole premise of improv is like, instead of just shutting everything down immediately, is to be like, yes, and. So like, you know what? I'm going to agree with what you're saying, and I'm going to add on to this to further this conversation so it doesn't.
People mix it up with time as.
Don't defend him.
Jason, just for the outtakes later this week, I stand corrected.
I am man enough to admit when I'm wrong, unlike other people in this room. I am man enough to admit that I am wrong, and I'm glad you came in to clarify
no,
this.
You're not.
I owe you and your people an apology.
No, you're not. Hey, do you guys?
I appreciate
you want to know what we're having for lunch today?
the velvet taco.
No, they switched it. We're having Thai food now.
Is that a joke? Did you write that yourself? You're so good.
Get the full scoop by checking out the archives at tastylive.com.
Financial markets are hovering in an uneasy state after another blistering rally last week as all eyes turn to central banks and whether they are going to bail the markets out of their weird, strange moment here as they digest what happened last time but look uneasy about what may come just yet. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we're going to unpack here what happened with the markets last week, then take a look at what's coming this week, because we do have another meaty dose of macro risk on the docket here. And does look like the markets are going to want to hear things from them. And we'll see what that is and why. But first, let's take a quick glance at what the markets did with last week's price action. We can see stocks continued to recover, up 2.9% on the S&P, up 3.4% on the NASDAQ. This time around, though, the bond market takes it a little bit on the chin. Yields come higher, which of course means bonds get sold off, and that happens across the curve, up 1.8% on the 2-year rate, up 1.3% on the 10-year rate, so bonds lower across maturities here. Gold in a little bit as well, down 1.7%, though it is rebounding here at the start of the week. That seems to comport with stock markets being a little bit brighter. The dollar manages to hold up a little bit better, up 0.7% against the euro. It nevertheless takes a back step against the yen. The yen manages a narrow increase even with a whack from the Bank of Japan last week, but ultimately not a whole lot of movement there. The overall story last week seemingly of continued edging back from the brink. April began with a very strong bias to sell stocks and bonds and the dollar after so-called Liberation Day, when the White House announced what it called reciprocal tariffs, but which amounted essentially to a kind of surgical carving out, almost amputation style, of the U.S. from the global trading system, and creating significant uncertainty around what the global trading order would look like, because of course the US dollar is the quintessential currency of global commerce. In fact, the Bank of International Settlements most recently estimates that it is 88% of global monetary transactions. This is not because the US does that much business with the rest of the world. It is only a quarter of global GDP, but it is because the dollar is so ubiquitous. Likewise, the U.S. Treasury is also ubiquitous as the risk-free asset for most global finance. And this is, in fact, a function of the trade deficit in large part. That trade deficit means that foreigners selling stuff to American consumers, since they sell it in dollars, end up with a big pile of dollars in their hands. And while they could repatriate those dollars back into their country by converting it into their own domestic currency, what that would do, of course, is pull the value of the dollar lower. And that would mean that those very same consumers that buy their stuff, those same U.S. consumers, they would lose purchasing power. And that isn't exactly a great business model, making your consumers lose purchasing power when you need them to keep consuming. And so the depth of U.S. financial markets in many ways reflects those exporters recycling their dollar profits back into dollar assets, into U.S. financial markets and the dollar, keeping the dollar strong, but also bringing down borrowing costs for U.S. consumers and the government. So in part, the reason that we've had, for example, relatively cheap housing loans and relatively cheap auto loans compared with, say, most of Europe, is because U.S. borrowing costs have reflected this inflow of dollar-based capital that has made for incredibly deep, incredibly liquid U.S. financial markets. And what that has done is, of course, benefited all Americans, but it has also made those assets, the U.S. Treasury bond and the dollar, inextricable from the global financial system. So when the administration moved to rupture the trade links that feed this system, there was, of course, a kind of hair-on-fire concern that the entire architecture of the dollar and U.S. Treasuries based financial order was on the chopping block. Now, the markets have since unclenched because the administration has softened its rhetoric and because seemingly people have come to the right conclusion that the dollar is so ubiquitous and so indispensable, for lack of an alternative, that even with all this chaos, it is still the pillar of last resort, as it were. And so what we've seen is a kind of unclenching in stock markets, a kind of unclenching to some extent in bond markets, though last week got a little bit spicier in relative terms. We're well off the panic lows in April. And now the question becomes that of more normal cyclical type of nature, where the markets back away from a more rabid concern about the architecture of global finance as a whole and settle more on the somewhat more pedestrian issue of global recession. And the idea that if there is, in fact, a U.S. slowdown underway, then that leaves the global economy without very much to stand on. And in that sense, we got some very interesting data at the start of this week, again, by way of stage setting. Here is the latest on S&P Global PMIs. As ever, these are done where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here with the revised set of numbers for April, we got manufacturing last week and updates on services just earlier today, these numbers were worse than expected. And what we find is that between manufacturing and services, the former at 50.2, the latter at 50.8, we've arrived at a composite at 50.6, appropriately enough. So hugging that center line down to essentially neutral, down to barely any growth at all, almost standstill. Compare that with where we were at the end of last year, looking at the strongest growth rates since back here in early 2022. So close to a 3-year high at the end of last year, now more like the weakest growth in 17 months. And this is really the upshot of where we are. We get the ISM services numbers today, and so we round out that PMI survey. Again, same logic. 50 is the center line, and all the same rules apply. You get a slightly better view on services here, 51.6 versus 50 0.8 for S&P Global. But of course, last week, the view on manufacturing was a little bit worse. So diverging in the opposite direction, 48.7, a second consecutive month of contraction, and at a faster rate for manufacturing here. Whereas ask S&P Global, and they think that services are a little bit weaker, but manufacturing is a little bit stronger, 50.2, so just barely eking out some positive growth. And so take all this together and you land somewhere near 50, and so near neutral for S&P Global. And take a look here, and you're at, let's call it 49 over here and 52 here, so you're kind of in the same space, somewhere around 50, maybe a little bit higher. So you get different kinds of surveys and different kinds of granular considerations here, but you can clearly see the same story in both. Here you have a slowdown over the past several months since the beginning of this year. Both services and manufacturing are heading lower. Here you get the same thing since the beginning of the year. And so with all of this, the story seems essentially to be one and the same all around. And that is, since the middle of last year, going all the way back to May, June or so, the story has been a strong U.S. economy and weakening performance for both the Eurozone and China. Why the Eurozone and China? Why are we singling these out? Why are these the top three economies? Well, as we've said many a time here, the architecture of the global economy is such that 58% of GDP is just three economies. The U.S., as we mentioned, a quarter of the whole there, and that's the largest single piece. The Eurozone at 15%, and China at 17%. That 58% together is already the lion's share of global GDP before we get into the realization that the remaining 42%, the rest of world here, are mainly vendors that rely on the large three to feed them demand. So think Canada and Mexico with the US, or Central and Nordic Europe with the Eurozone. Think most of the world's major commodity producers in South America or Africa, and of course most of Southeast Asia and East Asia for China. There's a lot to be said here for the influence of these three being even greater than their surface level 58% share implies. And so taken together, you then have a situation for the entire second half of last year where the U.S. seems to be the only game in town. Growth here is accelerating, and we can see why. Here we can very clearly see it's mostly thanks to the service sector, while China and the Eurozone flounder, and we can see that in this divergence of the manufacturing sector on the U.S. side, because, of course, the lion's share of U.S. services demand is fed by domestic firms. Whereas if it were goods demand, that's where imports are. And of course, this helps explain why the U.S. can be strong without spillover into a very obvious export market for U.S. consumers, China. China doesn't get that spillover because that demand isn't in the goods space, hence the anemic manufacturing. It's mainly services demand that keeps the U.S. economy so strong, which is how that demand stays domestic and doesn't spill over very much to boost global growth. And so you get this lopsided setup where if the U.S. were to slow, the global economy wouldn't have very much of a leg to stand on because the other two engines of growth are clearly misfiring. Well, here's where we are currently. The U.S. is doing exactly what you don't want to see, and that is converging downward on the standstill you now have on display in both China and the Eurozone. Now, we haven't gotten the S&P Global update for Chinese numbers yet to have a like-for-like comparison. The expectation is it'll be 50.5, but we did get the numbers out of officialdom in China, the CFLP PMI numbers, and they pointed to the standstill that we're expecting to see here. So it really wouldn't be much of a stretch or much of a shock to envision that outcome. And of course, with all of these PMI numbers now in the low 50s, the global economy as a whole appears to be grinding to a halt. With that, of course, comes the event risk that is front of mind this week. Monetary policy announcements from, first and foremost, of course, the Fed, and later the Bank of England. We'll start with the Fed here. We can see the evolution of these yield curves over the past several meetings this year, the January and the March. We can see here, and then this is the current curve. So we can see there's not really rate cuts on the menu until we get to July. So somewhere between July and September is when the markets are looking for the first cut. Now, obviously, these are the prices implied in the contracts, and if you were to really adjust them for the date of the meeting, there is no meeting in August, but if you were to adjust them here, and the meeting is relatively later in July, then you would expect the July number not to fully reflect it yet, but the adjusted upshot to show, in fact, that you do have a cut there, and indeed, the meeting is on July 30th, so right at the end of the month, and the probability that you have a rate cut there, basically 75% at this point. So as you look then at what happens, you arrive at the conclusion that this is where you begin. So you can see by the end of the year, you're essentially looking at 3 rate cuts on the menu. And if you look at the overall total here, it's about 70 basis points for this year, 31 for next. And so the market's in total at 100 basis points through the end of next year, which incidentally is pretty much in line with where Fed thinking is. Markets are a little bit more urgent. The Fed said in March, 50 basis points for this year, 50 basis points next. Here it's 3 and 1 with more stimulus front-loaded. The message from the Fed seemingly that they continue to sit on their hands and that they're waiting for hard data to tell them exactly whether they should be prioritizing employment, that is, the weakening in the business cycle that we're already seeing, or inflation, because they're concerned that significant tariff hikes, by the way, they've already gone up 5-fold, the tariffs, versus where they were before. That's even with the reprieve in April on reciprocal tariffs above 10%. That's because the average tariff for the U.S. before this latest move in April was 2%. Now, with the new baseline of 10, that's 5 times greater. The Fed has reckoned that that is likely to be something that lifts prices, but they're not sure if it'll lift inflation expectations, which would be the problematic bit if it started to feed another inflationary spiral. The evidence at this point suggests that actually the markets expect inflation to be down in 5 years' time, and that's because whatever economic downturn is being engineered by this policy will overwhelm with demand weakness any upward pressure on prices because of the tariffs themselves. And so the markets are already looking through the upward price adjustment and to the negative growth consequences and the downward price adjustment therein. Hence why they're looking for a little bit more urgency. But the Fed has signaled it wants very clear, hard data to tell them to start cutting, and of course to suggest that they need to be doing anything other than moving very gradually and slowly. And it doesn't look like they've received that evidence here, both in kind of a mixed bag jobs report and a mixed bag GDP report last week. So from the Fed's perspective here, there's probably not a reason to accelerate things. And from the market's perspective, clearly they would have preferred a more dovish take, hence what falling inflation expectations are suggesting, and of course, the greater urgency in the pricing here. So perhaps the Fed setting up to disappoint investors with what they ultimately signal. And then thereafter, the Bank of England due for a cut. That cut is all the way baked in here for May, down from 4.5 to 4.25%. And then we see that there's a further 70 basis points or so in the outlook, such that you can see from 450 now to 355 in December, you've had a 70 basis point shift here, or in this part of the curve after this cut this week. So in all, you're looking at about 1%, almost 95 basis points priced in for this year. And of course, with this cut, basically a foregone conclusion, you can see the remainder of the year has 70 basis points in cuts. So another 3 almost fully baked in. And then for next year, about a 50-50 shot for yet another cut, giving us a cumulative 83 basis points after this week's move. Now, that's already very dovish. And so the markets are perhaps hoping to get a little bit more intent, a little bit more guidance suggesting the central bank is ready to provide support, because if in fact we are in some sort of a global recession scenario, then it is the world's central banks that will need to lean in, with, of course, the Fed chief among them, but other central banks very much still on the hook to offer policy support. And so with the view from the Fed probably inconclusive, and the Bank of England already looking so dovish in its intent that there's probably little room to do much more, they, after all, also face a global tariff regime that's becoming less clear and less predictable, which is likely, again, to drive up costs and contribute to inflationary pressure. The story across these two central banks may well be that the global economy is slowing, but central banks are in no great hurry to do any more than what is already on the menu. That the incremental dollar of policy support or the incremental rate cut in an easing cycle is not forthcoming near term. That the markets are not going to get from central banks any more conviction to come and rescue global growth than is already priced in. And since the data seems to have suggested that the threat to global growth is rising, not cooling, hence this dynamic right here, and of course the most recent numbers out of the U.S. at standstill being kind of the most critical part of this equation, then you get into a place where, first and foremost, risk sentiment might find it difficult to keep building. Secondly, rate cuts might need to enter into the back end of the curve to reflect that central banks, and especially the Fed, delaying things now will mean they have to do more later. And tellingly enough, if we look at where we are on the S&P 500 in that context, as we can see, we've come off those April panic lows, just above 4,800 on the S&P, and very tellingly reverted right back to where that Liberation Day gap gave us the initial starting point for the sovereign kerfuffle, as it were, that we've just lived through. So the markets have essentially reset back to where they were right here. And how did they get here? Well, they started to come down from about mid to late February into mid-March around growth concerns, as the PMI data started to show that fiscal volatility in the U.S. was becoming a dampener on business and consumer confidence, and that this then was putting the brakes on economic activity and driving the U.S. economy to slow. If we are going to get a message from these central banks this week that suggests, yes, that slowdown is there and we're not ready to do anything about it, well, then perhaps we just get back after whatever this anomaly was to our regularly scheduled programming. And that looks like this. With that in mind, we're going to be breaking all of this down this week in more granular detail. Macro Money is here Monday through Thursday, right after Overtime, a show I co-host with Dylan Ranigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.
Of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Tasty Trade has crypto, and you can trade with zero commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
If you don't come from money, working with money sounds like the quickest place to get to money. So this idea of allowing money to work for you was fascinating with me. And then the more crypto, to be able to go where the opportunity is, I think is the most important. Getting hooked in a strategy, it's cool, I respect it, but I tend to think I like to go wherever the opportunity is.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, of course, Katie McGarrigle. Katie, welcome back.
Thank you.
I know you couldn't wait to get back in here after the weekend, and here we are.
Knocking down the door.
Yeah.
Kind of.
How was your weekend?
It's good. What did I do? Didn't do a whole lot. My dad was in town dog sitting.
Nice.
Spent a little bit of time with him. Took him to Aberdeen. He's a big fan of Aberdeen Tap.
So am I.
Yep.
So am I.
Yeah, it's a great spot for anybody that's in the Chicago area. Good food. I like their Southwest chicken wrap.
Great chicken wings as well.
Good wings. So I saw him. Watched The Last of Us. Had the normal Sunday scaries,
Okay.
as one gets.
Just general anxiety or alcohol-induced anxiety?
Just general anxiety.
Okay, yeah.
So if anybody has any, ways to prevent Sunday scaries, sound off in the chat.
Yeah, what's up, chat?
What up, chat?
If you're not in the chat, go over to YouTube, Tasty Live's channel, to be exact, and type something crazy in there.
Yeah.
Gregor, V-Dub, Katie, I just ordered your book.
I don't have a book. So maybe Julia?
Julia has a book.
The smarter brunette at Tasty Trade. It's definitely Julia.
Oh, don't sell yourself short. If you wrote a book, people would buy it too. Yeah.
Thanks.
Yeah.
I don't know what I'd write it about, but I'll have to workshop that in my free time. What did you get into this weekend?
I didn't do anything.
That's the move sometimes.
Yeah.
Especially when it's crappy out.
Cleaned my place.
I did a little of that on Saturday as well.
Yeah, exciting stuff.
Yeah.
Yeah.
Nothing.
Did you trade any crypto this weekend, Katie?
I did not. I offloaded a little bit with what we kind of saw last week, like a little bit more strength coming into Bitcoin. I offloaded a teeny tiny bit of my Bitcoin position, but.
See, I thought when you use the term offload, to me, you have like a container ship sized position, and you're offloading.
No, it was more like I just took some pennies, like boop, boop, boop.
Okay.
More like that.
Okay.
Did
it's like a little
you?
profit up there around 97 or so.
Yeah.
Nice trade.
Thanks. What did you do?
I didn't trade anything over the weekend. I bought a little bit of ETH when it pushed underneath 1800 earlier today. I just keep throwing good money after bad. We'll talk about that in just a second, but didn't really trade over the weekend, though I have been more focused recently on BitTensor. TAO, Tau is the symbol. It's not on the Tasty Trade platform yet, but we're going to work on adding to that list of tokens.
Yeah.
So I traded a little bit in there over the weekend, but no, I haven't done too much here, though we've been chopping around.
Yeah, I mean, and to your point, like there's just been a lot of new ads to the crypto offering at Tasty Trade over the last couple of months. And I don't think you guys have any plans of stopping. So
No, we're hoping to add another 4 tokens this week and then continuing to expand that list. So you can see the new list up here. Previously, you go back just a few months ago, there were only 4 tokens that are available to trade. That was Bitcoin, Bitcoin Cash, Litecoin, and Ethereum. We've added Doge, we've added Solana, XRP, SWI. I could keep going, but I won't.
XRP is having a moment.
It is. It is. When you look at some of our data, it's become a lot more popular recently. You've certainly followed it in the news. I think we talked about that to some extent with Hidden Road, with what they're trying to do with their stablecoin and trying to bring all these institutions to their ecosystem. Certainly benefiting from that. But one of the tokens that you can trade now through Tasty Trade, through Zero Hash, you can see the list right up here on the screen. And if you don't have crypto trading enabled, you want to trade it in your Tasty Trade brokerage account, really trade everything in one place. That's what I like about it personally.
Yeah.
You've got crypto, you've got stocks, options, futures, whatever else is coming down the
options.
pipeline. Futures options.
I feel like you're the crypto champion of the firm, and I'm like the futures options champion of the firm.
Oh yeah. I haven't traded any futures options in a while, though. I did come in. I came in long some gold today, so I'm patting myself on the back there.
Okay, I've got a free butterfly in there right now, and I've been short perpetually for probably 18 months. So
You can always flip it over and go long.
Well, as soon as I do, we're collapsing. So maybe
you let me know when you're ready. Okay. Yeah.
Yeah.
I'll be unloading, offloading.
I will be the reverse indicator.
But yeah, if you want to trade this alongside everything else at Tasty Trade, you just have to enable crypto trading on your account. You can do that within the settings section here. So you log into your account, or you can do that on the platform if you don't have it enabled. Cash or margin accounts, individual accounts, you'll see that button. Just quickly click that. It'll take you to the page, and then you'll be able to get started trading crypto if you want to.
Yep. Sounds great. So yeah, that's all I did. Very curious to kind of hear what your thoughts are. Especially since, I think our last couple of conversations, we've been towards the lower end of the range. And then last week, we obviously, as you mentioned, kind of started to nibble in those like upper 90s again in Bitcoin. So where is your head at?
Yeah, let's jump into the slides here. Let's talk about what's moving, Katie.
What is moving? That is like an unflattering picture of me. Like I look like a thumb, just saying, but... what happened to the photos that we took? We took some updated ones. We need to get those into rotation.
Yeah, we do. We need to reload here. I appear a bit confused, per usual. Let's talk about what's moving. Here's our performance dashboard. I updated this in the morning. We're not too far off of these spot prices. I've got Bitcoin on the Tasty platform right now at 94.5, 94.1, chopping around here today. I guess my takeaway recently has been to stick with what's working.
Sure.
So you'll see here, and this has been the case for a few weeks now, if not the last month really, Bitcoin's been resilient. It's not the same as most altcoins. It's not to say that there aren't opportunities in those, but Bitcoin is in its own category. And you quite often see that reflected in its performance. That's what's been apparent recently. So you look at the price momentum, it's been bullish in there. The volatility didn't explode when you saw risk assets really jump off a cliff earlier in the month. And so while I'm tempted at times to try to buy dips, I told you how I'm throwing good money after bad, seemingly, in ETH, and I'm finding other opportunities at times for trades. I think when I look at that long-term kind of buy the dip, this is an environment in which, I want to be long Bitcoin, probably leaning a little bit more heavily on that than I am in something like, memes or even Solana at this point. Translated, trading that implied volatility, one standard deviation, everything here is telling me that, I still want to be in Bitcoin market cap dominance over everything else. We haven't seen that rotation into other tokens, which I think you will see, but it's probably after we've seen Bitcoin go up a bit more here.
Yeah, makes total sense. And I feel like, to your point, like there's starting to be more chatter around like regulatory clarity and like what plans kind of look like. So maybe we'll kind of continue to see some of that, as you said.
Yeah, volatility has come in here quite a bit. So that's one thing I'll point out, that the IV rank for Bitcoin is basically at 0.
Yeah.
ETH is low as well. And then realized volatilities, because we don't have options markets that we trade for Solana, for XRP, or others. So we go off of a 30-day realized volatility. We annualize that vol. And we've come down back into the 70s, kind of mid-80s for some of these tokens. That's relevant. It might look high, but it's low versus the 120% or 200% that we've seen some of these trade at times. So not necessarily trying to caution anyone, just be aware that some of these moves that you're seeing are pretty low. Volatility is pretty low in there versus what they can do. It doesn't mean that they will do that, but moving, 1% or 0.5%, 1% to 2% per day is a pretty small move versus what we've seen.
Yeah. It's just so interesting, like, when you say that, because when I'm on the show with Mike and Nick, as you often are as well, weren't you on today?
I was, yeah.
Like, if I'm ever presenting a currency trade, and then I go and I'm saying, yeah, I'm seeing, I want like a little bit of a pullback in the euro or something like that. And then I have to go and tell people, and I like look at the implied volatilities on the platform, and they are always like single digits, if not very low, like teens, more or less. It's just wild that, I guess it's all relative, to your point. Like,
this is on that other end of the spectrum.
Exactly. Like where I'm like, 15 is like really high implied vol for the euro,
Which it is. I mean, for a currency, right, that is extremely high volatility.
Right. But 70 is just like, it's not yawning activity for Bitcoin and some of these other coins, but it's low relative to, like what you said, 100, 200 realized vol.
Absolutely. Yeah. So just be aware that they can explode higher in volatility terms. Not that they necessarily will. That said, quite often, you see those volatility explosions or the expansion there when you get that big up move. That's how we get that plus 200% volatility because these things are screaming higher where they can at times. So that's a quick look at our performance dashboard wrapped around 94,000 here, a little bit of a pullback. This is what I think people should pay attention to. That trend in there, the 3-month price performance has still been deeply negative for most tokens outside of Bitcoin. Bitcoin down 7% in the last 3 months. Year to date, though, flat. But everything else versus Bitcoin has just really underperformed. That's what I mean, again, by for now, and this will change. It could change as early as this week. But for now, I'm mostly focused on trading Bitcoin.
So what do you, go back and what do you think the catalysts will be for some of that rotation?
Partially, it'll just be price across the space. I think when you see people make money, let's say the gateway is Bitcoin, or you've seen big fund flows into those ETFs. Once you get to a certain point, people are going to look for a relative outperformance in other areas or look for those laggards like you do in the markets in any other capacity. So I think, let's just arbitrarily throw out some numbers. Let's say Bitcoin runs from 95 here. And if we think that this is at $100,000, it's a 50% realized volatility. Annualized, that's 150 to 50 is your one standard deviation range. Big move. But let's say it pushes up towards 150. At some point, I think that people are going to look for other opportunities. And it's not to say that you won't see other tokens run in the meantime. But if you don't see that resulting performance in ETH, in Solana, I think eventually people just say, okay, wait, is this going to play catch up here? There might be a reason to take some profits over here and then get into any one of these tokens that is going to have a much smaller market cap, given the idea is that they're all positively correlated. Right. Maybe there's an environment in which Bitcoin completely detaches from the performance of the rest of the market. I don't think that's something we're going to see. Still very, very small in the grand scheme of things when you think about the size of the asset class. We just recently got back to 3 trillion. We've been higher before, but it's just not that big when you think about the size of gold or the commodity markets, for example. And so I think there's still room for others to run, even if Bitcoin does march higher. I don't necessarily think, and could be proven wrong here, but there's a world in which you see, Bitcoin go to 200,000 and ETH is stuck at 2,000, or Solana stuck at 200. Maybe Bitcoin market cap dominance would be at almost all-time highs. I don't think that's the case. So I think you could see a little bit of that. And then I just think you need, a macro environment that's a bit more conducive to capital flowing into these highly volatile assets.
Yeah, that's what I was going to ask you, because I was looking at information from the SIBO today. I get their reports from time to time, and they talked a lot about, the explosion in zero-day options, which is no shock to anybody that's been in the markets for the last 5-6 years since they've gone live. But one of the things that they called out is obviously with the volatility we've seen in April, there's been a pullback in retail investor trading of them, of course. So when you say we just got back to 3 trillion in Bitcoin, is that due to what we kind of saw in April?
So we came off of, I don't know exactly what I can go and look at. So not just with Bitcoin, but you look at the whole space. What's the total market cap of crypto assets? And I might be able to pull that up really
I guess that's the better question is, with the volatility we've seen across the market as a whole, did people dial back in April?
Oh, absolutely. Yeah. Yeah. I mean, you saw, a pullback in some of these tokens where maybe not so much just in April, but really where this started to materialize was in February, beginning of February. You saw a lot of this start to sell off. You had monster moves in ETH, for example, and you're still down, what do we have up here on the screen? Still down year to date. In ETH, 47%, down 37% in the last 3 months. So this happened before April. It was fuel on the fire there. But yeah, we saw some meme coins, AI agents, other areas of the market draw down 60, 70, 80% in some cases.
Right.
Bitcoin had a 30% pullback, which is quite normal, I guess. When you look at this historically within bull markets, what are the corrections you should come to expect? Well, those corrections are 100% within the realm of 20 to 30% down. That happens quite frequently. We just got that. It's encouraging that the price action is, trading in a little bit more bullish fashion here, back up to 94, 95. but you absolutely saw, what happened in other markets spill over into crypto.
Right.
So I think you need to get to a point again where, okay, what pushes Bitcoin to that higher level, and then what pushes people further out on the risk curve? It's probably, a bit more certainty around trade with the tariff situation. So we have a bit of a pause, and some things were kind of walked back from the beginning of April. I think you need some clarity out of the Federal Reserve. Right now, they apparently are on hold. And you need some clarity out of the economic data as well. We've come out of just recently reports where you can see that slowing in GDP. You can see a little bit of that slowdown, and certainly in inflation as well, that was starting to get priced into the markets, which are going to front run this data. That was starting to get priced in back in February, in March. And so we need to get out of that environment, one that's more conducive to taking risk, one in which the Mag 7 and tech stocks do well. I think crypto will do well. But in the meantime, lower interest rates and the weaker dollar are certainly presenting a decent setup for Bitcoin.
Sure. Yeah. Fair enough. What else is on your mind? Anything are you knowing that, is there anything that you would think about in, some of the corresponding ETFs, or do you want to talk through some of these other coins?
Yeah, I guess a couple things that stand out to me. I mean, it's hard to ignore SWE's performance recently, up 52% in the last month or so on a relative basis here versus Bitcoin, up 41%. So there have been some recent pockets of outperformance over the last month. I still think, you're kind of going to go into this overweight BTC, but this is on my mind, SWE. I think you're going to see, or, you're starting to see some signs of the reemergence of that AI narrative, the coupling of AI and blockchain technology, or decentralized intelligence. So I mentioned Tau earlier, a couple other tokens that are on my radar. Render, this is one that you can get through the Tasty Crypto wallet. I also think that things like Virtuals token, some of these agent platforms, you go back to AI16Z,
right.
You're kind of seeing signs that a lot of these have probably bottomed. Doesn't mean that they're just going to launch higher, but you're seeing some growth spurts there. So that's another area of the market that I've been paying attention to. But yeah, it's really just trying to trade, some of the pullbacks in Bitcoin and the other tokens, but being aware of, where that's going to go, or could go, I should say. So here's your one standard deviation moves on the weekly.
Yeah. Okay. So we've got 88,000 as the low, more or less, in Bitcoin, and 100K back on the high end of the range. Okay, nice. And then you said you layered into some ETH when it was under 1,800 today?
Yeah, I couldn't help myself. I just bought a little bit for a second. But yeah, that's one where you just haven't really seen that stair step higher in the expected move. You haven't seen the same trading in terms of price action that you've seen in Bitcoin, where what we've seen in Bitcoin is that implied volatility move. The volatility has come in a little bit, so you have a smaller move, but it's implied a range of higher lows and higher highs throughout that process, where ETH, Solana, and others have really just been stuck chopping sideways. And I think you're going to see that chop continue for some time until, again, you get more of an awareness of the liquidity situation, of what monetary policy looks like going forward. And it doesn't necessarily have to come out of the U.S. It's just that there's a lot of uncertainty right now that I think is holding back new money from participating in some of these different tokens.
Sure. But, something that I think is interesting that, again, I've talked about with you when we've done the show before is the idea that, especially if you have the trader mentality, it can be, I should say, different if you are going and looking through the investment lens. So knowing, if you're saying, yeah, sure, maybe there's more chop sideways, but if you have a longer term assumption that ETH or Solana or some other, coin that is listed might ultimately, bounce, why not?
Yeah,
nibble
absolutely.
on $100 or a couple, whatever your size is, so to speak.
Yeah, I mean, I think when you look around the market, there's decent evidence that a lot of these have probably put in the bottom. It doesn't mean that you won't revisit near that low. We'll see if this is true for equities or not. They're trading a bit better as well recently from that momentum perspective. But I think there's decent signs, ample evidence that, with Bitcoin, I keep wanting to use that with crypto interchangeably, but with Bitcoin specifically, low being in there about 74 or 75. The same thing with ETH, with Solana. It doesn't mean that they go straight up, but I think you probably have seen the worst of it. Anything going forward is likely going to be liquidity positive, Fed lowering rates, possibly monetizing. We'll see how that all plays out. All of these things on the margin should be positive for crypto. And I think, again, we've gotten out of kind of the worst of the tariff situation that drove volatility to those kind of extreme levels.
Yeah. So when you're doing and nibbling on your like crypto positions or like looking to like layer in a little bit more, are you, and knowing like you said that this one's kind of not necessarily been working out, are you putting it in as like all one transaction, $1 amount? Do you try to like layer in like with a couple of different prices? Like,
oh, I'll try to dollar
this
cost
level,
average in.
$50 to this?
Absolutely.
Okay.
Yeah, it's not like I'm sitting there and saying, okay, I've got $1,000 here that I'm going to put into a trade, or 10,000, or whatever your arbitrary value or amount is. I'm going to look at, okay, I want to be long this because the trend is bullish. This is the implied range, and I want to buy dips in that range. Knowing that it's not static, it's going to move around. It's possible that I never get to the bottom of the range, but maybe if the Bitcoin range is 88 to 100, I'm feeling a lot better given the momentum is positive in there or bullish. I might buy 90, 92, 93. But it's not firing everything you've got in one shot. It's knowing that, okay, now I have $1,000 that I want to allocate to this. Maybe I do it in tranches of $250.
Yeah.
But you're just dollar cost averaging in.
Sure, makes sense. I've also noticed that, and we've talked about this a little bit, but more so probably Mike and Nick than you and I, but you're back on the follow page.
Yes, but I can't get it to work, so I haven't been able to post anything. So we're going to work out a technical bug. I'm not sure what's going on, but I am back on the follow page. Thanks for the shout out there, Katie.
Yeah, no, I just wanted to call it out, and maybe apology. Maybe I front ran it while we were trying to troubleshoot you.
No. I tried to post something the other day and didn't work.
Well, we'll get a little loud.
I forgot about that. Yeah, right.
But I think it'll be helpful to see that, like, especially when you look in the chat and people are just talking about certain coins or have questions or anything like that. So drop your questions in the chat anytime you all want. But I'm looking forward to kind of seeing how you navigate both the crypto space as well as some of the ETFs, just the equity markets as a whole. So looking forward to having you.
Yeah, I mean, look, at these levels of implied volatility, they certainly can go lower. But the range in there for Bitcoin is probably about 40% or so. To 70% on the upside when you look at implied vol over the last year. I'm just buying call options in IBIT.
Okay.
Like that sounds kind of silly, right? I know it goes against, we want to sell premium here at times. There's no premium to sell.
Yeah.
How
far out in time?
I'm going out, let me double check and see what my actual expiration is here. It was like 200 days. Yeah, 200 days, November 21st, so end of the year. Giving myself enough time. I just think the upside volatility is really cheap. You need a massive delta move, but on any sort of upside move here, you're going to see volatility come back into the marketplace. So I think there's an interesting setup. It doesn't mean that it's going to work. It's a lower probability trade, but arguably upside call options, tails, whatever you want to call them, are arguably cheap. I mean, cheaper than they have been for some time.
Yeah. And like you're saying, like I think sometimes, and especially given, like, I think what tastylive posted on social today, which was like Tom rating different trading trends, and YOLO options was one of them. But I think there's a time and a place for something like that when you're saying, if you see something cheap on the board, you want to participate in a defined risk way. You know what the trade-offs are in terms of like putting capital aside for either long periods of time or understanding that in some asset classes, like that bullish behavior will actually, reduce the volatility or the price of that option. You just have to know what the trade-offs are.
Yeah, and there might be ways to finance it in the meantime, right? I was for a little while selling puts and just going to run the wheel strategy in there, though I never got assigned. So I was just selling cash secured puts or puts on margin in IBIT. But I don't really want to do that at these volatility levels either.
Okay.
So I'm comfortable with the small position that I have. I think I've got about $1,000 allocated to 3 different IBIT call options, and those strikes are 70, 85, and 90.
Okay.
And that's 200 days out. So it's a little bit of a lottery ticket. But in a world in which you absolutely see crypto prices explode, then I'm very excited to hold this position. Otherwise, it's it's just a trade like anything else.
Yeah, and I mean, to your point, like the 70s, the 85s, and the 90s, like, they're a little bit wide, but when you are just buying a single option, you can be a little bit pickier with your price.
Yeah, absolutely.
And I'm talking, when I say wide, I'm talking like 10 cents, 15 cents. So
yeah, the 85 is 6 cents wide.
Yeah.
Like you mentioned, the 70 is 15 cents wide right now.
Yeah. But if you look at the open interest, like clearly there's other people thinking the same thing.
Yeah.
So.
Yeah, this is a cheap way to get that exposure for maybe what's coming next.
Well, I might have to take a look at these because I currently in my portfolio do not have any IBIT. I was in a trade, I think it was like a crab trade with Nick, where I kind of rolled out a part of it and then covered the other bit on my own. So I'm in the market, as they say.
Well, volatility will probably go lower in the near term.
That's
but
okay.
Could present an opportunity. And given how much time you have here too, it's not like these options are going to go to zero in a week if the price doesn't go up.
For sure. And for me, and for those that maybe don't necessarily watch the show that me and Mike and Nick do, or you as well, my typical bread and butter risk tolerance, I like that $1,000 in spread width for a defined risk trade, maybe $1,500 in spread width, depending on, my conviction and or how many other trades I have on at the time. So if I am buying an out of the money 70 call in IBIT 200 days from now, $400 is in line with my other trade size. So it's not imbalancing anything else that I would necessarily be doing.
Makes sense.
Love it.
Well, that's going to
be back.
Yeah, thanks for coming on the show, Katie. That's going to do it for our show here today. If there's anything that we didn't cover, you have a question on, shoot us an email, support@tastycrypto.com, or just hit us up on Twitter. You can hit up me, Katie, or @tastycrypto on Twitter, on X. But that's going to do it for our show. We will be back on Wednesday. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Stephen and Lan, thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content, and I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
You were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator.
I appreciate you calling in. Good stuff as always. Thanks, man.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Hi, my name's Angeline Ong. I'm the newest member of the IGTV team.
Well, I began my career at CNN Financial in London, covering everything from the financial markets to the European trading day. What I'm looking forward to working with IG is to be the best version of myself and to use all the skills that I have and help IG reach out to those clients out there who are, like me, looking to learn and are ambitious and willing to put themselves out there to learn more about a financial instrument they might not have ever used before. My philosophy is, if you're going to play, why don't you play big? Let's not settle. Let's try and learn more and become a real expert in the field that we are trading in. And that's what I hope to bring to IG in its strategy, in its content, and expand that across Asia, the US, and also Europe.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. CBOE is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the CBOE's SPX pit. Watch Liz and Jenny live from the CBOE, only on Tasty Live.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts. Some people say it's insane. That's what I do.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it's Monday, May 5th, everybody, or so they say, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast. You ever a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world, and I'm on one today. and a decent number of incentives to explore for the day. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of the conversation, bing, right here on your screen, there's only one place you can do that, and that's over on Tasty Live YouTube channel. So head on over there, find the channel, find the video if you can, and jump in the chat. Subscribe to the chat first in order to see your comments, both appropriate and otherwise, on top of the screen, and just start banging your metacarpals, your phalanges, your skull even against your keyboard. Create random ass characters and spoof the Google algorithm into putting us in front of as many people as possible. Shout out to all of you already in the chat. I see you. I missed you. Grumpy Mike, what's up? Lone, Catan, Emmett, Mark, how are you? Victoria, Jay, Soul Train, and so many more. I would sit here, just shout you all out, but I'm contractually obligated to say something that could be interpreted as something of substance. Red on your screen is what they will say, I suppose. A little bit of red after what, 9 straight days? 9 straight days. Can you think of anything you've done for 9 straight days? 9 straight days of rally broken today, for whatever that means. That's such a silly thing, you know what I mean? When people start we count so many things in markets for no reason. You know, this is the 3rd time in the last 14 years on a Tuesday, on after a full moon, where we've seen a down day. You know what I mean? We do all that weird stuff. It's like, this is not helpful. None of these numbers, none of these random ass numbers you're throwing at me are helpful in any way. Anyways, S&P 500 down 2/3 of 1%. The NASDAQ, a whole bunch of the same, down 2/3 of 1%. Brian got it. Brian got what I was. I wasn't going to say it, but you were thinking it, and you were right. Dow Jones down 0.25%. The Russell down 4/5 of 1%. So nothing doing across any of the majors on the day. But Vol, you can make an argument. Didn't stray too far. I mean, what are you going to do with 0.2%? That is down. However, with VIX and volatility at 24, we should be, at least theoretically, experiencing 1.5% moves, or at least inside 1.5% moves, and outside 1.5% moves 2 out of every 3 days, or 1 out of every 3 days, excuse me. So technically, a contraction of volatility was probably in the cards for a day like today. But you just got the cash up to 23.64. Near-term VIX futures at 23.25. Let's get a beautiful look at that VIX term structure if we can. And guess what? It's still in backwardation. You know what we should start doing? We should start taking bets on how long the VIX curve is going to be in backwardation. There is no way to know this unless you see some date out in the future that you think is going to be in some way, shape, or form meaningful. Maybe that 90-day, coming to the end of this 90-day tariff pause, maybe that's a decent time frame or window to bet on. Maybe that's actually decent. I think the longest that we've seen in recent or modern history would have been 2011. And I think we were backwardated for something like 70 days. We can't make it all summer in backwardation, can we? He asks. Can we? Yeah, maybe I'll put together a running chart. Well, we'll start to count the days we're in backwardation, and that way you can throw out more meaningless numbers. People say, we just broke a 9-day rally in the S&P, and you can say, oh yeah, we've been in backwardation for 13 days. Then you can both stare at each other and then go, what do we do with this information? And the other one goes, nothing, it's not tradable. Sorry. But yeah, 24, it isn't it funny how 24 VIX all of a sudden seems manageable? You know what I mean? If I would ask you maybe 3 months ago, what would you pay for a 24 VIX world? You'd be like, oh, bro, give it to me, man. I'm tired of this, pops to 18. give me something of substance. Now here we are in backwardation at 24, and you're thinking things have kind of calmed down. I guess 24 volatility regime sounds or is inexpensive relative to a 40 VIX regime or relative to a spike to 60. Bonds, my babies, it got ugly. Daddy got lucky. Daddy got real lucky. I'm sorry, I'm referring to myself like that. I got a little lucky last week. I told you guys I was shorting the long end of the curve, very short-term trade at 117, though I felt it was a little bit of no man's land. So effectively, I flipped a coin last week, and it worked out. Just get lucky sometimes. We the long end of the curve headed down towards 114. And I closed it out at the tail end of last week. Why did I close it out? Just some of the commentary coming out of the administration and some of the commentary coming out of China. I was like, ooh, I'm kind of nervous of a bit more flattening here. Again, the general premise, the negotiation goes poorly. The negotiation with other countries, but in particular China, if that negotiation goes poorly, I see that as a steepening event, an event that could raise the long end and lower the short end. People expecting cuts imminently, given the financial ramifications of poor negotiation and tariffs that are left at their same level for a long period of time. You can see economic scarring and need some sort of response. And if you get the opposite, you get some sort of light in the negotiations tunnel. I thought you'd see the opposite, some flattening in the curve. I don't know if that's the right way to think about it or not, but that's my current mental model. So I close it out on Friday. And a quick look at the curve. We didn't really, we came in. I don't know if that's the right mental model. We did come in a bit. So we were at 65 basis points, I think at peak. When we started to see a changing of the rhetoric of the U.S. administration, which then subsequently saw some easing of, I think, the Chinese rhetoric in turn. We've gone from 65 basis points. We got as low as 50 basis points at some point last week. Yeah, on Friday. Oh, I timed that pretty well. And then we've kind of bumped up a little bit. We're at 53 basis points. And this is between the 10 and the 2s. This has nothing to do with the 30-year, by the way, but it's a decent general proxy. Maybe I should start using the 5s and the 30s. So, the interesting thing I think about the curve is you're starting to see that short end is playing against, we've had this range, and I don't know, maybe my eyes are just picking patterns here because we've got a couple of curves on the screen, but it does seem we've established some sort of range here. 3.6 as our low end yields and effectively 5% as our high end yields. And that is where this market is playing inside of. Whether or not the short end gets all the way down to 3.6, can you imagine getting the Fed funds rate all the way down to 3.6? I don't know if they'll go that far. I don't know if they can go that far. Maybe we get to 4%. We see what's what. At least that's what the market is pricing. But 3.6 low end yields, you can see it here. That was effectively where the 2 years, where the 2 year was when we started to cut back in September. The high end is effectively where we were. I don't know, what was that, 3-4 weeks now back when we saw that temper tantrum in the long end of the curve. Post Liberation Day, I cannot believe he called it that. I still can't believe he called it that. I can't figure out if that's genius level marketing or just the most narcissistic gaslighting attempt of all time. It's maybe a little bit of both. Speaking of cuts, my babies, real quick before we get into a little convo, a little back and forth. Yay, Alcatraz. Yeah. You know what's funny? you did it, not me. Okay, you got me going off this direction, Grumpy Mike. But like, what my original premise, I had this, I sat down a couple of years ago and I just was like, all right, what themes do I want to bet on what I thought was going to be likely continued wealth inequality. So I'm like, all right, if you just put 10 people on an island and 2 people have all this stuff, what would those 2 people need? I swear, this was kind of an exercise I went through. I was like, what would those 2 people need? And I was like, they would need guns to protect themselves from the other 8 because the 8 want their stuff. And they probably would need, like, best case scenario, you want like a jail. You want somewhere to throw those people for minor infractions so you don't have to deal with them trying to steal your stuff. So it was like this what's where the concept for, you know what, I should look at private prisons. And I never considered the idea of using an entire country like prisons as a service. I understood the idea of sort of moving from public prisons as a public service to a private service, but like El Salvador is effectively exporting prison services to the world. And then I was like, well, then when I hear stuff like we should reopen Alcatraz, I'm like, yep, I know where that's coming from. I totally understand where that's coming from. More on that later. But to the point, I'm sorry, I got a little distracted there. To the point here, interestingly enough, they've got a little hawkish here. They got a little hawkish. So we had a meeting June 18th, and for most of, I was called the last couple of months, the cutting cycle has started in that June meeting. And now, given some commentary, numbers, and the like, they're actually voting, they're actually, the implied curve here in Fed funds futures are saying that might not happen, that there's only a 1 in 3 chance that they cut in mid-June, and instead it starts in July. What do you guys think about that? Do you think they need to start cutting earlier, sooner rather than later? You like June, or do you like waiting? It feels like this is what always happens, right? It feels like there's a moment where they probably should cut, they wait too long, and then they trip an event, and we get forced into a monetary and fiscal response. It seems like what always happens. Me personally, I do not think we should be cutting 4 times this year. To me, that sounds crazy. The other thing I did at the tail end of last week was short the 2s. I never mess with the 2s, but we had this conversation, I believe it was on Thursday, and I said, you've got 4 cuts built into the curve. What would you bet? The over or the under? I could go to... What the hell? Paul fell asleep on the controls. Just kidding, man. I love you. I think that's a way of his way of telling me, hey, spice things up a little bit, guy. You're getting a little boring, a little repetitive. If we've got 4 cuts priced into the curve, how do you bet against it? You could sell SOFR, or in my case, I just wanted to sell the 2 years outright. So I'm short a little 2 year. Let's see what you guys are saying. Wow, Catan says he says June. Get him going. Grumpy says June 2026. Here. Not many people taking guesses. All right, you don't want to play this game. You're like, you know what? I'm here for your predictions. You're not getting mine. Yeah, I kind of like the under here, and I'm short the short end of the curve for just a little bit. If these came in, honestly, it's probably a decent area to probably close it. But for a while anyway, I'll keep it. I tend to agree. I think they've overdone it. I think eventually they're going to get forced to cut, and they're going to get forced to cut more than people expect. Are you kidding me? Paul? Oh, you ran. I see. Never mind. You ran the credits too. Paul literally just played me off like this is an award show. Wrap it up, B. So yeah, I'm at 4. I think we talked about this. I gave reasons why I think they could do either, why they could front load their cuts or why they could slow walk this. And I think where I landed last week was I think they're going to slow walk it. I think they'll play Mr. Magoo with any of the data. I think the reason they're pumping up the tariffs as the catalyst is it gives them the opportunity to sort of hide behind them. The reason, what's his name? The reason Jerome Powell dropped the transitory word that freaked everybody out was because he's giving everybody a heads up that, like, hey, even if we see, or we may see some warmer inflation numbers, but we're not going to act. And we're not going to act because we expect them to normalize. Didn't work out well the last time. I think this time, I think a lot of people actually agree. But the problem here, as I see it, is it's like that is the I don't know, I'm just crazy. But if we're in an economic war, okay, just go with me on this. Put your tinfoil hat on and just go with me. If we're in an economic Cold War, which I believe we are, then we are at our most vulnerable when inflation is on the rise or at its peak, and everyone sort of is now expecting it to roll over. So what's interesting about the last time inflation was rising, it looked like it was rolling over. People were sort of expecting or positioning for the fall of inflation. Then guess what happens? Russia invades Ukraine, and it becomes really, really problematic. And in a way, and it's just like it's like this accelerant. It's this huge problem because we are wearing this position we're wearing this inflation position. We need it to roll over, and the question becomes: do we open ourselves up again? If you see some sort of short-term inflation, or you see inflation and you don't do anything about it, do you open yourselves up to a vulnerability to economic attack? I don't know if that's the right model to think about this, and maybe this correlation is not causation. But I remember I was talking to my wife, and I was like, look, this is the most vulnerable time for America. And then, weeks later, Russia invades Ukraine. And it sort of seems like if we put ourselves in that position again, I don't want to know. I don't want to be right this time around. All right, let me pause for a second. I'm just blasting through your guys' comments. My bad. Not even saying what's up to my friends. Not even acknowledging all the sick work you guys do. Honestly, your guys' comments have become part of the show. All right, let's see. What's up, Lucid? Welcome back, my friend. Soul Train says 9 straight days of losing at stocks since Liberation Day. 9 straight days. That means you lost them going up and down. Yeah, this is one of those times where you gotta have some conviction, because they're shaking everybody out. Need closed caption with sound off in class. Oh no. I feel sorry for anyone that has to read me via closed caption. That's like reading a Trump speech or something like that. It's really made to be heard, not to be read. closed on my short vol this afternoon. Huge sigh of relief now. Congrats, Max. I know what that feels like. And you're just in time for the vol crush. You're just in time for them to crush us down to 18 and go back into contango. We can say oversold for months, Victor. Oversold in what terms? What can stay oversold? Do you think we're oversold right now? I agree with the statement in general, but Catan, I don't know what you're referring to. Alex Catan thinks Alex Karp was on that booger sugar. That's pretty funny. You think Alex Karp is a weird dude? What makes him weird? I mean, I think he's eccentric for sure. He's an interventionist, and I suppose you kind of have to be in that to run that type of business, unless you just have no principles and you're willing to sell for any reason. I don't know. I saw that conference of the speech he gave the other day when he dealt with that heckler. I say dealt with it, responded to a heckler. If you haven't seen it, it's pretty interesting. I like when people let the heckler speak and then try to respond. Because that's kind of what our whole thing is, right? I'm not a big fan of like somebody stands up, starts saying something, and then you throw them out. Like I prefer, if you've got the mic, give them an audience, and then take control of the stage that you're on with the microphone. Say, all right, I let you say your piece. Let me respond. That person clearly wants to be heard. Make them feel heard. Give them a response directly. Ask them to take a seat. Stay for the rest, and then tell them you give them an audience at the end of the show. I think more people should do that, but they're sort of afraid of being confronted with their own ideas, I think. So I appreciate, regardless if I agreed with his point of view or not, I appreciated how he handled a moment of confrontation with an idea that ran contrary to his own. I get really disappointed when just people just go, they tug the ear, security comes, just drags the person out. I'm not down with that. You know what I mean? You're in a populist era for a reason. People are really pissed off and they want to tell you about it. And I think more people should have to sit there and take it, or even better, grab the mic and respond in an open audience. Isn't that what this whole game is about? You got to be able to stand there and be more eloquent and get more people on your side. And if you can't do that with the microphone and the stage, then perhaps you're not on the wrong. You're on the wrong side of that issue. I'll do a couple more and then we'll get back on. We'll get Cruz in here. Adam Green says, those two people need, it's like Powell is taunting Trump. Those two people need just one thing, religion that declares them the messengers of God, or capitalism, where they have the most capital. Fear of unknown is the operator. That's funny. All right, I'm going to keep going here. Can you talk Buffett retiring and the future of Berkshire? I haven't thought much about the future. I don't really follow his business as deeply as I should. I guess. I don't know. Maybe I should. I did listen to him, and there was a part of me that was like a little sad, you know. There was a part of me that heard it in his voice. He sounded different this year. And it's probably time. And there was a bit of sadness that I had as I was listening to him speak this year. And it's but they have likely created a succession plan long ago. So I don't know. If I had to guess, I don't know that they'll deviate too wildly from what's made that business successful in the past. I think it's really hard. What's hard to replace maybe it isn't the strategy. It's hard to replace the brand. It's hard to replace the brand of a Warren Buffett. The guy who lives in a, I don't know what, it's the nice house in Omaha, but, it's I don't know what it's worth now, but it's certainly not a multi-million-dollar mansion. And at one point, it was in the hundreds of thousands before we printed all this money. A nice place in Omaha, eating McDonald's every day. Horrible decision. I don't get that. But sort of the no frills brand, the folksy no frills brand, doesn't really exist anymore, right? All the people in finance, in money, and in technology, they want you to believe that they're super smart, they're super elite, they are cosmopolitan. And he was sort of this folksy brand from Omaha, Nebraska, who believed in sort of very simple cash flowing businesses until Apple. He was totally ruthless, but the general public didn't see that. It's the end of an era. It's a bit sad, but it's probably time. I haven't really thought about it much more than that, to be honest. Why do you think Warren Buffett hasn't bought back into the market, says Nicole. I want to be really careful about answering this question because I don't know what other people are thinking. But I'll answer it this way. I have a higher than normal percentage of cash, and I haven't bought back into the market materially. I took some bets at 5,000, at below 5,200, so 5,200, 5,000, and then 49-ish. I took some small bets that were short-term in nature, and those bets paid off. In hindsight, could I have found some assets that were probably attractive to buy at that level? Maybe. Probably. But I also think, I still think this is a very two-way trade. I think what's happening now is the people that panicked at 5,000, they're seeing a market that kind of got away from them. And then, so what happens is when you go, oh crap, I'm the one who panicked, and either I sold or I didn't buy anything, and now the market's moving higher. You play the chasing game, right? Because you didn't buy 5,000 or 5,200, so 5,400. You go, oh shit, I gotta buy, and then you get them goosed for another couple hundred points. But you look around and you go, at 5,700, 5,800, are these things of value? And I still think the answer is probably no. I could be totally wrong, right? You get a couple of trade agreements, the tariffs get lifted, you've got to deal with probably a quarter and a half of bumpy data, but you're probably feeling okay. And then if inflation continues to come down, it gives the Fed an opening to cut, maybe not as early as people think, but later. And so I think you could see a world that starts to look rosier, and that could mean, who knows? That could mean 6,000. something in that ballpark. But to me, I go, if you started the year at 5,000 and I asked you what your upside was, if you said 5,700, it would probably, and I asked you, is that a good year given the risks that you're facing in the market? You'd probably say, yeah, probably. So I don't know. I just think in order to put money to work here, you have to either be afraid of how the U.S. is going to treat the purchasing power of the dollar, and you're just in it for protection against devaluation of currency, or you have to sort of believe that you've got relatively good value. And I just think for me, we haven't hit that yet. We haven't hit it yet. And maybe I'm just not fast enough. Maybe 4,900, maybe in that ballpark, 4,835 where we got to. Maybe that there were some interesting deals there, but I just wasn't fast enough to be ready to deploy enough money at that level. We weren't there fast enough. And then here's the other thing, man. You're getting paid. The really big difference about this market is you're getting paid 5% to take no risk. And I think, you're getting paid, you can get paid between 4 and 5% to take no risk. And so the average long run return of the S&P 500 is it used to be 7%, but I think after all the massive gains over the last 5 years, something like that, now the average return probably is like 8, 9, 10% is probably what they use in school now. So let's even call it 10% and be aggressive. It's probably not, but let's just use 10 for easy math. You could get half of that with no risk. So how much risk would you take in a world where you can get half of the expected return of the S&P 500 taking almost no risk other than purchasing power? So, at some point, rates, they start to offer competition. If you're in a zero interest rate environment, which we were in for such a low period of time, or low interest rate environment, we never have to have that conversation. You never have a conversation of the risk-free rate being competitive enough to convince you to keep money away from equities. You especially don't think like that if you've been in an environment where 20% returns on an annual basis is the expectation, not the exception. And if we're going to a world where that normalizes a bit more, if 20% annual equity returns is not the expectation, but the exception, and recessions once every 7 years become normal as they were prior to GFC, then 4 to 5% in a riskless yield starts to look really interesting, I think. So yeah, I guess that's where I would go with it. Let's see, Jeremy, mark this down. Fed will not cut rates this year. I think that's possible. I think it's more likely no cuts this year than 4 cuts. I don't want to say that. Let me say the best case scenario for the Federal Reserve, I think, is that they open a path so that they don't cut. They don't have to cut. Jeremy, that's a bold call, man. Jeremy, somebody screenshot that. Jeremy Wallace on Monday, May 5th, 5:42 p.m. Central Time. Mark this down. The Fed will not cut rates this year. And if we get to not even the end of the year, bro, if we get to like September and that is still live, I'd like to replay this clip. Catan, that's the truest thing ever said. We are not the only country that will experience a higher term premium, folks. Correct. Jesus, correct. Everybody. The central banks are pretending, at least for now, that they've left the game for buying debt. I think I would say, yeah. Which means these governments now have got to sell these pieces of paper into the open market. And they've got to do that now, where their debt and debt trajectories are already massive. And it is possible to get back on better footing, but you got to go through this world of pain to get there. And whether you take moderate pain, whether you take more aggressive pain, that's up to the powers that be. But selling this stuff into the open market without central banks, the help of central banks, that is going to be expensive. Who wants this stuff? But again, I could argue when people were trying to explain, I remember having a conversation in an office with a guy who I deeply respect, and him trying to explain to me, I think rates at the time were like negative 50 basis points. We had negative real rates. And he was trying to explain to me why he didn't want to buy risk assets at the time, why he wanted to buy bonds. And I just, sometimes I come at this as a very simple-minded child, explain this like I'm 5 years old. And buying a negative yielding asset, a riskless negative yield, I just could not wrap my head around why that was an attractive prospect. But there were people out there doing it. And so I suppose, markets can operate in a way that I can't conceptualize. Not I suppose, I'm sure that's correct. But I don't see how term premium's got to go up throughout the world. I completely agree with Catan. This should not be surprising. One of the more interesting things that was said today, while I'm on the topic, came from Treasury Secretary Scott Bessent, who said in some remarks today, because he gave some spicy, juicy jewels he dropped today. One of the things he said, U.S. Treasury Secretary Bessent, the way to cut deficit smartly is to bring it down by 100 basis points to GDP each year. Why is that interesting? It's interesting because they're now sort of giving actual numbers. They're putting a lot of color around what was, I think they called it strategic uncertainty when we started this whole thing. And week by week by week, they're starting to color in their playbook a little bit more for the marketplace. How aggressive, what should we expect in terms of the budget, the deficit, trade agreements. Week by week, they're sort of dripping out their strategy a bit more to the marketplace. So I found that to be a little juicy tidbit. Victor, how are you buying treasuries to get the 5% through Tasty? Yes. There's two options. I talked about this last week. I think everything matured. I don't think I have any treasuries right at this very moment. But there's two ways to do it. Well, that's not true. In my Tasty account at this very moment. But there's two ways I do it through Treasury Direct, which is the U.S. Treasury's website, which is absolute hot garbage. The technology is like 20 years old. Or directly through Tasty. I prefer doing it through Tasty because I get some credit for the buying power. So I can hold the money in my Tasty account. It yields in the Tasty account, and I get some credit for the buying power of the Treasury asset. That's my preference. Direct 1 month or 4.3%, exactly. What are bank rates right now? What are cash rates at banks? Are they still on the floor? I guess I haven't even checked, because I got so used to a bank not paying anything like it should because it's a bank and that's how they make their money. So I got so used to just going around the bank and not expecting them to pay me for the cash that I haven't checked it in so damn long. Because that was always the risk, right? Post SVB, that everyone was just going to go straight to the Treasury, take money out of banks. Grumpy Mike says, Bessent put out a number. Trump will say something different tomorrow. Lutnick will say something that contradicts them both. And then here comes Navarro. It's funny, but it doesn't quite work that way. I think Bessent is... I have not seen Bessent get contradicted yet by Trump. I think him, Lutnick, and Navarro have different points of view. They also have different jobs. So if you had a team of people, and those three people are, I think, have three different jobs, and sometimes their point of views come in conflict. I see, like some leaders are consensus builders. Like a Jerome Powell, right? If you look at the amount of dissent on the Federal Reserve in the decisions that we've made under Jerome Powell's leadership, in particular past the pandemic, I think, what's his name? Jim Bianco. Sorry about that. Jim Bianco put out actual statistics around the amount of dissents on the Federal Reserve since Jerome Powell's been chair. There's very little dissent, which means he sort of leads by consensus. He's a consensus builder. I'm not apologizing for this. I'm just telling you what I see with my own observation. And why am I trying to observe these things? Because observing them as objectively as possible will determine how I make bets. And I want to try to be as objective about these things as possible. So this is what I observe. I observe that Trump is not really a consensus builder when it comes to leadership. He's one of two people. If he's dealing with people who he gives the benefit of the doubt, who he believes are strong, then he lets those people have their own opinions, and then they float trial balloons in the public and allows him to see which one of those ideas are popular or unpopular. So he walks back the unpopular opinions. It has nothing to do with the individual, and he lets the team of people who he believes are strong talk openly about their opinions. Weak people, or those that he deems as weaker players, he keeps them under his thumb a bit more, contradicts them often, and that being contradicted sort of keeps them from making very aggressive statements without checking in. So that's my observation. And so when I think they contradict each other at times, I don't think it's some grand plan or some 3D chess type thing that's being played out, but I do think he tries to use it to his benefit. If Lutnick says one thing, Navarro says another, and Bessent says something else, he's kind of judging which one of those three things is more popular to the public. But that makes it, the downside to that is there's very little certainty that comes out of the White House. There's very little certainty. So you kind of got to put the pieces of the puzzle together. I was thinking about this actually before the show, real quick. I don't know if this is, some of you guys are going to like this little detour I take, some of you may not. But I was thinking about this before the show. I remember just a few years ago, when the U.S. administration, for the most part, right, they're going to give you a set of promises. They're not going to be big promises. They're very small. You kind of knew what you were going to get out of the U.S. administration. And then when it came to monetary policy, the Fed would put out these pieces of paper, and they weren't trying to play this game with the marketplace, or the game that they were playing was fairly well understood. And it was easy. It was really, really easy. When you really think back to like what the world was, maybe like prior to, I don't know, 2019, I guess. It was really, really easy. And I feel like we're in this world now where you have to do so much more work. You have to do so much more work to try to understand what's happening, what pieces are being moved, and for what purpose, what pieces are on the board that may be moved, and how monetary policy and fiscal policy and geopolitics and foreign policy, how all this stuff is mixing together. And for the macro people, I think they love it because they get to sort of express a value proposition that they've been unable to express for a very long time when you just had cheap money and people that could go out and just tell narratives about equities, and that was the game. You didn't have to do anything. And now we're in this world where you have to work to figure out what's going on. Nobody's telling you what's going on. And if there are people telling you, it's very often colored through a political bias. So it's hard to get sort of an objective view of the landscape because everybody's so sort of dug in. There's a lot of sunk cost, put it this way. If you were an opponent of Donald Trump, you have sunk cost in the opinions that you've expressed in displeasure that it almost becomes impossible to celebrate anything that goes well. It becomes impossible for you to even see when things are going well. And then on the flip side, those that have sort of hitched their wagon to the MAGA movement or the Trump movement, they've got a ton of sunk costs too. It becomes really hard for them to see any issues with the way policy is being executed. And so I just find ourselves in a very interesting point in time where it's almost impossible to get an objective lay of the land, and you have to do a ton of work yourself. And I think for those people that can remain objective and that have a decent logic, this is an interesting period of time. If you are used to getting the playbook given to you by some piece of paper from like Morgan Stanley or something like this, or the 5 o'clock news tells you what to expect from monetary policy and it's right, that period is over, man. It's long gone. If only Besant spoke. If only Besant spoke, people wouldn't be freaking out. McNutty, I agree with that, actually. But the problem is in my personal opinion, you need Navarro. In order to maintain trust with the single actor in Besant, you need the Navarros and the Lutnicks. You kind of need a scapegoat. You need somebody to go out there. I'll say it this way. When I worked at a certain firm, there were days when the markets would be down 2%, okay? And we'd get a call from media, okay? One guy was a gangster. He would go on, he would take those calls, rain, sleet, snow, or shine. It didn't matter what the market was doing. He would take the call and go on and help retail traders, in particular through volatility. A lot of other people, beyond that one person, would not go on when markets were down. So markets would be down like 2 or 3%. And no one would want it. And that's how I got my start. People go, hey, the market's down like 3% today. Nobody wants this opportunity. Do you want to go take it? And I was like, oh, shit. Okay. And that's how you started to see me on television, because a bunch of people didn't want to go talk about markets in volatility. Ironic when you think about it now. It's actually probably the best time to go. But anyways, that's kind of like, you need one of those people to go out there and talk about the bad news in order to keep the golden goose looking good. If you catch my drift. Though I do think Navarro definitely makes a bunch of unforced errors out of ideology and passion. Or that's, I'm doing him a generous interpretation. You could say ignorance on the other end of the spectrum. Bitcoin at 95. Who would have thought, baby? Kicking myself a little bit for closing out some of this Bitcoin position, but just happy to have some exposure to the upside here as we're getting back to 100,000 and nobody talking about it. Maybe they are. He literally spoke on CNBC like 3 hours ago. Yes, Drew, he did. I think he was on CNBC, Bloomberg. He did a little run. But Bitcoin at 95, some part of me knows that when we get to 100, I should probably close the little exposure that I have left. I would really like to put some like deep out of the money upside exposure in Bitcoin for the end of this summer. I really would, but there's no efficient way to do it. You know? Like, one, in the futures, you can't really go out very far, and you lose a ton of slippage on these things. MBT is not so bad, but I don't think the same problem with the options. And they're smaller. Can only go 50 days out. IBIT, I just don't like this product yet. I like, give me something like the SPY, you know, that tracks 1-to-1. I hate these products that don't track mathematically. I really do hate them. Yeah, if you were going to put a upside, I want to put a super cheap upside bet on in Bitcoin for like late summer. You know, give me a good product. Like SPY, you know, 1 to 100. Why can't all products be like that? Like USO to crude oil. Give me a GLD to gold. SLV to silver. None of the TLT to, I guess it's not really bonds. It's like an average 20-year maturity, but just give me simple ETFs. Super liquid. Change all this stuff and just go 1 to 10. Or 1 to 100. 1 to 1,000, depending on what we're trading. Uptick says Ryan is long calls and IBIT 200 DTE. Yeah, I want some end of the year upside in Bitcoin. Why? For two reasons. I see this working. I see Bitcoin working at the extremes of both ends of the distribution. So on one end of the distribution, the right tail, I see if you get, and again, I'm talking about the ends of the distribution. I'm not saying this is what I expect to happen, but on the right tail of the distribution, you get a bunch of trade deals. You get China that sort of plays nice. You see a relaxation of tariffs. Not that they go away, but they're probably somewhere like where the market expected them, sub 10% or below. You get a resolution in the Ukraine war. You get a resolution with Iran. You get some sort of resolution in Gaza, or working towards a resolution. I think that one might be the furthest away, unfortunately. But if a lot of these things happen, you could start seeing, you get the tax cuts, and a sort of a straightforward budget that people can now start to plan against. You could start seeing a really, because the next quarter is probably going to be a lull, right? All the data is going to be a lull. And so just on base effects alone, on building on top of what that could mean, you could get a really interesting back half of the year. So that's right distribution, where all the things go right. They go well. The left side of the distribution is things go horribly wrong, right? You trip credit, the basis trade blows up, the carry trade blows up, some new thing, some new esoteric risk, some super leverage trade that nobody even is talking about right now. Private equity blows up, corporate real estate blows up. You get another SVB or bank run, like anything on the left side of the distribution where credit gets tripped. Things that we know, like gray swans, things that we don't know, like black swans. Well, in that situation, you get forced to do what we've always done. And then you could see a world where that puts a bid in Bitcoin as well. So a play in Bitcoin, for me, it's a hedge of a wide distribution curve, and the wider distribution curve hitting. I think what's the worst case scenario for Bitcoin is probably things stall out a bit, nothing escalates, nothing de-escalates, or very few things de-escalate. You get somewhat positive direction in policy, but in a broader sense, things feel a bit stuck. Or economy starts slowing down, but not slow enough for anyone to get fearful about credit. I think in both of those scenarios, inside the distribution curve, this asset becomes not very exciting. Yeah, so I'm sort of interested in it for that reason. I should talk to Ryan again. If he's got some crazy upside long calls, I want to know why. He said 70, 80, 90 out of the money calls, 200 DTE. I really like that. I really, really like it. And it's kind of the idea that I was thinking. IBIT is probably the only thing you can go into, not your eyeballs ripped out or be over levered. But I don't love that product. IVR is 24, so I guess the right time to start buying calls in it. Yeah, maybe. But its vol isn't the same though, is it? Is Bitcoin vol in the 45s right now? I haven't looked at it in a while. That'd be crazy. Let's keep going. Gold finally found some footing. That didn't last long, did it, people? We ate off of it, which is good. The question becomes, yeah, they didn't give us much of a discount in the miners to buy either. I suppose my first thought, maybe Barrick, my first thought was, did any of the miners get cheap enough to reestablish a new position? And the answer is probably largely not. I guess Barrick Gold, so GOLD is not too bad. Not too bad. Some of the stuff had a nice discount off highs. I don't know if it got cheap enough. That's sort of in the eye of the beholder. There's nothing that stands out as an obvious. Let's check the miners, the mining ETFs. Not really here either. They just don't want to sell these things. and good on them. These things are criminally underowned. Go ask a friend if they own a gold miner stock. See what they say. Now go ask them if they own upside Tesla calls. See what they say. I bet you'll find more people that own GME and AMC stock still, bag holders on all that stuff. I bet you'll find more bag holders on that trade than people that own gold miner stocks, just anecdotally. Vic was a gangster, says Nicole. I appreciate that. For some reason, you know what's wild? You know that saying, what was it? I was born in the darkness. What's that whole quote? I was born in the darkness. You were merely something, something. That's sort of how I feel about volatility. High vol regimes are my absolute favorite to trade and my favorite to talk about. Low vol regimes, I hate them, and I'm actually I don't think I provide a lot of value in them. Like what you need in a low volatility regime is you just need a knucklehead that keeps telling you to buy highs and sell higher. You need that knucklehead guy. So I don't provide a lot of value in that world, and I know that about myself. But when vol goes crazy, everyone's freaking out, and I'm kind of guy that says, all right, take it easy, tell me what happened. It's like when my kids come up to me like emotional, they just got into an argument or something like that, like, all right, let's sort this out, let's fix the problem, then let's find the opportunities here. And so it's sort of funny to me that I've talked to producers who have said this as well. Like when vol spikes, you can't find anybody to come on these shows and talk, which is hilarious. Because that's, in theory, if you were trying to make a career for yourself talking about markets, you probably want to make it a habit to go on television and make decent calls when vol's crazy high. Because one, you'll differentiate yourself, and two, it always, I don't say always, but like you have sort of a Federal Reserve backstop against the crazy outcomes. All right, let's talk silver a little bit. I'm still waiting on this bad boy to pump to the upside. Crazy upside MSTR calls are very expensive. Yeah, I saw Canadian Jennifer, I think on Twitter, put out some interesting work on why she was getting aggressive in MicroStrategy. Or it's not, I guess it's strategy now. What a mistake to try to rebrand that company right now. I'm still playing upside, out of the money upside silver calls here, silver call spreads. Why? It's because I think people are buying up gold as a monetary asset. I think the spread between the monetary asset of gold and the industrial usage of silver is wide because people are nervous about growth, and rightfully so. But if people are going to take equity risk here and they're slowly taking some Russell risk over like S&P and NASDAQ, that's what's called the broadening out of the rally, and what typically will come with that if the market believes it, you can get maybe perhaps a bit of a silver catch up here. And so I'm still long silver, even after that $3 rip. Crude oil, to me, this is the most fascinating trade. It's like people are punishing crude oil just because the administration needs it. You know what I mean? It's like the Patriots trade to punish crude oil. It doesn't matter what happens. Sell crude oil, sell it. Got down to 54 and change. And the lower this thing goes, the more pressure it puts on Russia. In a deal in Ukraine. So two things are working for the administration right now in Ukraine. One, the minerals deal, getting that in hand gives you the opportunity then to turn around and stop being so the administration is trying to pretend like they're sort of this neutral arbiter of peace. But in reality, it's like, give us the minerals. Give us the minerals and then we'll help you. That's kind of what that was. That's my read anyway. And then on the other end, you need a lower crude oil price in order to put some economic pressure on Russia. Which is the craziest thing, The craziest thing is sort of believing that embargoing 10% of the world's oil supply was going to in some way help us, How we make these decisions, and you can't say it in public. At the time, if you say anything about how that's a horrible idea, how people need oil, someone is going to buy it, and they might buy it at a discount, but they are going to buy it. And the only person that's hurt is everyone else who's removing supply, and their energy costs are going to go up. But if you said that at the time when you announced these sanctions, people are like, oh, you can't say it because there's this like herd mentality of people right now in the zeitgeist. They go, you're a Putin's puppet. And you're like, you don't even, I bet you couldn't draw out a simple supply and demand curve right now if your life depended on it. And you're calling me a Putin's puppet because you don't understand simple economic concepts. But anyways, I digress. That was a real strange time in human history. So the question is, I think we'll round out here. What do you do with risk, or what am I doing with risk? It's really, really hard for me right now to fight this feeling of FOMO, and want to play the next 100 points to the upside, because I could totally see people. They just weren't positioned. They weren't positioned well for positive change. They were positioned well because people extrapolate out linearly, right? It's recency bias. It's the news I'm hearing now is negative, so let me extrapolate more negative news into the future. So because people are freaking out about tariffs, we're going straight to the Great Depression. It's like, okay, yeah, maybe, but maybe that's not the way things work. And so people, I think, were under positioned for positive change or positive developments, and you've seen a lot of that. But I think at the moment when people are going to feel comfortable actually deploying risk into the market, the price is not going to be attractive. I would argue 5,700 is not that attractive. I think at 58 and above, it's depending on what we see from a lot of the data here. Some things have been better than expected, right? The jobs report was better than expected. That has a big reason, or has a lot to do with the Federal Reserve, people changing their expectations on the cut trajectory. The data this morning was not terrific, at least on PMIs. I think the ISM was better than expected. So we've gotten better than expected news, The world is not instantly falling apart. And I think what do we got? This was supposed to be the week that your grocery stores are starting to go empty, right? That's not going to happen. And I just think people were very, very underprepared for positive change. Which is unfortunate. And now one of two things is happening. Either you're a professional player, you can't afford to underperform, and you got turned into a chaser, or you're on the retail side and you got freaked out by people talking about the end of days, and you didn't get to participate at all in the last, what was that, 900-point rally? Insane when you think about it. 900 points in 4 weeks. And now, guess what happens? You don't get any of those people freaking out on TV or on the internet. Your Twitter feed turns bullish. Your YouTube feed turns bullish. But the price no longer supports an incremental dollar into that theory or into that thesis anymore. That's a long way of saying I'm neutral. I've hedged my portfolio deltas down to effectively flat. And I'm going to get burnt if the next 400 points is to the upside, then that's the wrong move. I'm not going to get hurt, but it's opportunity cost. I'm going to pay opportunity cost to the market. But if the 9-day rally we just saw, if this breaking of that now starts, okay, they've chased them as far as they're going to go. Now let's find the real price, maybe at 5,400, something like this, 5,500. Then hedging up is going to look like a great move, and I'm going to save myself a couple hundred points to the downside. So that's where I'm leaning. But hedging is not really hedging. It's really just taking a directional opinion, And it's only hedging if you are right about the move. So that's where I'm at. I'm effectively hedged up on a lot of my portfolio delta. I have some bets. My bets right now, I'm short the ZTs. I have a little straggler put, a downside put in ZB, but it's like nothing, which I'll probably remove pretty soon. So I'm going to end up being flat. I had a little straggler like M short gold position, which needs to get closed out. I mean, it's tiny. I think it's like an MGC contract. It's the last of a handful of stuff that I had on. So I close out of the GC shorts, close out of a lot of the MGC shorts. I have short upside calls in gold. I'm short the 3,500s with something else bought behind it. I have upside calls in silver. And those are all the bets. Not a ton, but more than usual. Grumpy Mike says tariffs are so last month. It will be until they escalate again. And if they don't escalate, then I'll be wrong. But the more interesting thing to me is when they escalate, in my mind, when they escalate, whether or not the market is going to read through that. Because I could very easily see the next escalation is you escalate to de-escalate. That's kind of a strategy in war. And I think clearly they're going to confirm the talks soon. And I think that might start the beginning of the peak in optimism here. And then you get the actual negotiation. And I think once you start negotiating, you get escalation. There isn't this kumbaya, this dance. There's clearly a dance here that on the U.S. side, our administration is trying to paint them as needing to cave, and the Chinese side is doing the exact same thing. They're playing to their own domestic audiences in order to open up a pathway for them to just confirm talks without either side looking like they caved. To me, that's what's happening. It's a, interesting, funny little political dance that they're doing right now. And when they get done with the stupid formality dance, it's like this weird little mating dance that we have to watch them do until they finally pick up the phone, confirm talks, and then start working on the terms of trade. But when that happens, and if they escalate to try to get certain points in the negotiation, is the market going to try to look through that? That's the more interesting point than whether or not they'll escalate, because I do think they will. Let me read read here. Have not been to the grocery store in a couple of weeks. Can't say the shelves are full or empty. Schrodinger's groceries. That was really clever. That was really clever. All right, everybody. I think that's going to do it for me. If you want, do me a favor. You can follow me on social media. I am on X and X only. Technically, I'm on IG, but it's private, and I haven't accepted anybody in years because all I'm doing is sharing videos of my kids. So Twitter's the only place I rock. So you can find me at Victor Jones. The Owen Jones is 0 because I like to be difficult. Let me ask you guys, what's the best social platform? I want to ask you that question before I get out of here. My wife and I had a bit of a, I don't want to say an argument, but a debate over this. And I said, hands down, Twitter is the greatest social platform that has ever been made, and it is still currently the best platform. I said all the other stuff is like least common denominator. It doesn't take a lot to take a duck face selfie, but just, they'll have to excuse me if I don't think that's particularly interesting to engage with. So I'm not super, Instagram's not really my jam, and I'm not even on TikTok. I've never opened an account. I'm not on the thing. Because I some part of me still believes in the idea of nuance, and I don't know that I can get that in 6-second clips of people dancing. So to me, Twitter's hands down. I think it takes a lot to sit down and put some words on a piece of paper. And I tell my son this all the time. I said, I don't know, I'm dragging this out, my apologies, but I tell him all the time, both of my kids, not to use their hands to solve their problems. Use your words can change the world. And I think at some level, a platform that emphasizes the usage of words, man, we need that back. We should force everybody on Twitter and then put an age restriction on all the other platforms. If the only thing kids could do is write, if the only thing the kids had access to, only social media kids had access to until they were 18, had no video, no pictures, only writing. You could only express your ideas through writing. Do you think the world will be a better place in 20 years or a worse place? I think it'd be slightly better. You can follow me on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. You can send me an email if you have something more personal or you'd like a one-on-one audience at victor.jones@tastylive.com. And do us a favor, subscribe to the channel, and I will see you back here tomorrow. Ilya Spivak on deck for tomorrow, I believe. We haven't switched it. So Ilya Spivak on deck for tomorrow. I'll see you back here same time, same place, same great network, only on Tasty Live. Peace.